Little bonus session this week, anatomy of a trade. We've reserved this segment a little bit for my daily profit plan in the mornings. We've had some deconstructed segments during the typical, 60, 90, 120 minutes that we're live every single day. Wanted to have a little bonus session today and tomorrow on anatomy of a trade, which basically means it's kind of like an ask me anything. If you would like to, discuss different strategy types, I'm looking primarily for, option strategies today. If you want to talk about forex or futures, that's fine. Obviously, if you're long stocks or ETFs, that's fine. Ways to diversify, that's fine. But I teach and I run a lot of services that are options heavy and options related. And the more I can keep breaking down those barriers, accelerating that learning curve, getting traders on board with the ability to trade these markets up, down, sideways. There is a great book, Annie Duke, Thinking in Bets. It is a great book. If you want to think about trading, you want to think about, everything we do decision wise is based on probabilities. I actually had mentioned, golf is not a game of perfect is like a sports psychology book. Thinking in Bets is a great trading book, even though it's not really trading related, but it is probability related, especially when it comes to options. That's essentially what we are doing each and every day is thinking in probabilities, thinking of mechanics, thinking of strategies, things that work, stick with them, be persistent, manage risk. Okay. So we had taken some notes earlier this week on some strategies that I had some followers that were interested in. They were asked about the butterfly and iron butterfly. We'll discuss that. Those are the way that I like to use those personally. It's a low risk, high reward strategy. I think of this, and I'll take some notes along the way. So anatomy of trade, what can I help with? We have a YouTube video that I've already done before. If you see any of these similar thumbnails that show anatomy of a trade, trading 101, strategy session, anything that looks like this, same background with a different heading. I've done a lot of those just trust content videos, options 101, things like that. You can find those in my YouTube channel. That's youtube.com/Chris Pulver. Okay. So what we talked about this week, so Tuesday, Wednesday, we'll be doing anatomy of a trade. I'll get through as much as I can today in the time that we have. If we need to come back and, revisit some of those tomorrow and clarify, I'm happy to do that. If we can, get through more strategies tomorrow, I'm happy to do that as well. But these are some of the ones I'd like to discuss. And what I'd like to do is also make this relatively consistent on the type of asset we're trading. So if you want to talk about a butterfly, iron butterfly, if you want to talk about a jade lizard or a calendar spread, diagonal spread, whatever the strategy is we discussed today, even if it's simple calls and simple debit spreads or credit spreads, let's look at it from the perspective of like one asset. Personally, I trade SPX a lot. I trade SPY a lot. I trade Qs a lot. Those are the most liquid tickers in the world. They're index related. If you'd like to avoid a lot of unnecessary volatility that happens in the individual stock selections, trade the indexes. There's plenty of credit and there's plenty of availability. There's plenty of liquidity. There's plenty of choices. There's plenty of directional bets. Literally, you can trade these markets every day in a 0-day environment, and you can obviously space it out to whatever time frame you want. I have option trades that run for 0-day. I have options that run for a week. I have options that run for weeks, months, quarters, half a year, full year. I'm constantly going like short term to long term. And I'm typically not further out than maybe 1 to 2 years in a lot of my trades and my portfolio management, just because I always want to make sure that I have some dry powder and some dynamic abilities where I can manage risk to the best of my ability. Okay. So let's go after it. I'd like to see if anybody's jumping in the room. First and foremost, say hello. I'm going to do this as well. I'll spot let me see if I can bring up the chat. Can I put this on the stream? So I can bring the stream up as well. If people are commenting, let me see if I can pull this up. Hide chat overlay. Can everybody see this, by the way? I'm curious what this looks like on YouTube right now. Are you seeing comments? There we go. So making some comments. Yeah, okay. So if those pop up, that's fine. I'll get some questions in here. I'll kind of toggle this on and off. Let's get to the charts. So option strategies for up, down, sideways trades. Just a quick look at the markets today. We are getting some green once again. It's nice to see a bit of a recovery. I did have the screenshot ready to go for my final hour session today. I think this would be an important thing to watch structure-wise. So what we are dealing with right now, I mean, current price is 67.51. Looking at this live right now. So this is SPX live for the morning. We had a nice winner today on daily profit play. We're getting some additional income, looking pretty good. Our out of the money trade percentages for waterfall income looking really solid as well. A couple of trades we can take a quick peek at. I just want to review this since I'm in the options platform here. Waterfall. These are December expirations. We obviously have some time in these trades. Up about 15% on that one, up about 55% on this one. This one's not too bad. This is a January 16th trade for waterfall income. We pulled in $1. It's up 55 cents. If you want to take that credit, get the buying power back, that's a great trade. Your probability of profit in this is 97%. I don't think a lot of chaos will happen until January 16th. That's our expiration. It's about 52 days. I'd like to think the market is a little bit more robust and resilient than just to dump roughly 15 to 20%. If we get down to 58.10, I think this is a trade that we had filled recently. So 58.10 from current price, we'd have to drop quite a bit. 58.10 would be, we'd have to drop another about 14%, which is going to be roughly a 15 to 16% correction in the next 50 days. So anyway, anything could happen. But I had this screenshot ready. I was going to share this today for my final hour. Last week we had that massive sell-off on Nvidia, right? So it's not just Nvidia; it was a little deleveraging, a little tech-heavy, sell-off. This was the gap up because of Nvidia earnings, and the market just absolutely smashed lower. And this was the third time in 30 years that the price has done this intraday. We gapped up over 1.5%, and we ended up ripping down over 3% to finish, over 1.5% in the red. That's only happened 3 times in 30 plus years. So that's a pretty big day. You can consider that an outlier, but here we are staring at price right now, just off of the Nvidia sell-off candle high. This structure does make things pretty interesting. I would say that the bulls, need to do some more work. If they can get up here through the holidays, that would be a little bit more reassuring for the markets. Just talking like short-term technicals, because my concern is that we have 2 massive candles, and I talked about this a little bit this morning. These 2 massive candles from October 10th. So this candle put in a nice solid low, and then this candle from last Thursday, November 20th, put in a solid low. Technically speaking, my concern is that we have maybe something like this setting up. Connect the dots right here. Is this a left shoulder head to neckline? And all this recovery because of this bigger structure candle, if this is just a recovery back up to a lower high, does the market come right back down to the neckline? It's really important that this neckline holds through the holidays, not just Thanksgiving. I'm talking literally through all the news and stuff we're going to have to digest in December. It is really important that the market stays above this like 60, we'll say 65.50, 65.30 zone. If it doesn't, I would just measure symmetry, because a high, low, lower, high, lower, low will have we'll have an idea of where that symmetry is. And also, if it's a head and shoulders pattern, then you would measure it with a high to low, and you'd go from the neckline and you'd measure symmetry that way. So potentially we could have symmetry down to about 6,300 or symmetry down to about 6,100 if it overshoots. 6,135 previous highs or 6,140 previous highs. Measured move down to about 6,100, maybe 6,000 as a potential bottom, right? So again, these are my technical concerns moving forward. This is alleviated if the market is able to get back to these highs. If we get back to the highs, this could be a retest of the top. Some might say, well, I think this might be a double top. Well, maybe it is. If it's a double top, it comes back down to retest the same October 10th and November 20th candle, and then we break that and we measure that move as well. Similar measurement. Okay, it's going to be this high to low measured out. So that's if we start to see a downturn. But where we are at right now is we're back above the 50-day on the exponential. I pulled this out this morning. Did I cancel that workspace? Maybe I did. No, I built it here. So I just built this out like simple MA. And the 50-day, this is the simple moving average, has been reclaimed by the bulls today. So after that Thursday sell-off, 1, 2, 3 candles to the upside, we've regained that. I think that's encouraging. What the bulls would also like to see is, can your shorter term moving averages cross back up? I'm going to put another one in here, either an 8 or a 9. Let's go indicators. Let's go simple. Okay, so simple should default at a 9. Let me see if I can get an 8 in here. I like 8 for a fib. Okay, so it's a pretty aggressive one, right? See how the 8 moving average is crossed over? If the 8 period can cross back above, if this can cross back above, price continues to rally up. That's a little bit more encouraging that the bulls have regained control. And again, testing the highs, maybe even going higher. I still have my concerns that this might be just a choppy range. This might be some type of broadening pattern. We got to watch for that as far as like the bigger picture goes. The one thing that I've said, in the earnings environment is we are in the top 1% of earnings, meaning like the Cape Shiller ratio, highest valuations ever during the dot-com bubble. Obviously, it wasn't a bubble until it burst. Um, but I mean, we saw the Nasdaq up like 50 to 100% year after year for multiple years until the bubble burst. I think it was like an 8 or 900% stretch during the dot-com bubble, and the Nasdaq is up, since the bear market in 2022. Nasdaq's up like 95%. So there's still a long ways to go. I don't think that really the idea of a bubble, I think people have no clue like how, 20 years removed from the dot-com bubble, I think we would be shocked to see how bubbly this market could get to the upside before we actually have a big correction. So, does that make me crazy bullish? No, but it doesn't make me crazy bearish either. I think it's a very difficult task to time the market to be bearish. And if you try to, you end up wasting most of the time. You waste money. Peter Lynch has a famous saying: most people lose more money waiting for correction than actually getting correction, which is very true. If you are heavily short, heavily hedged, do not make it cost an arm and a leg. Very rarely have I traded the markets like aggressively bearish outside of some asymmetric hedges. Even during COVID, I was bearish going into 2020. I had no idea that COVID was going to be the reason, the catalyst that the market used to dump 30+%. But those hedges that I had going into early 2020 worked out extremely well. I would say it was more lucky because it happened so quickly. But at the same time, as COVID was happening and the markets are down 25, 30+%, I looked left on every chart and it's like, oh my gosh, this market has literally given us like a decade of a discount. And I just started buying stuff. And it was small and it was percentage allocation and it was taking option trades and it was selling premium. And it worked out, really well through the rest of the year and then even into 2021 with that crazy melt up until we had a deleveraging in 2022. So all that being said, we're still in a bit of a interesting cycle. Like we're just above the 50-day moving average on the simple. We are still just above the exponential. If we can reclaim, like I said, this 8 period crossing back above, I think the bulls get a little bit more reassurance if they can get back into the 6850 to 6900 zone. I have an immediate concern if we don't take out this Nvidia sell-off candle. Let's say that we turn, tomorrow we have the day before Thanksgiving. Let's say the market turns south. That wouldn't be encouraging because we're still trading inside of that Thursday candle from last week. Okay. So if we stay inside that candle, be cautious. I will be cautious. We will address this stuff every single day during my daily profit play. All right. So just doing a little bit of housekeeping and maintenance, daily profit plan. We're in this thing every single day. Today we had a really nice winner in our strategy. We took about 50% profit, which I'm really happy with. That's a great trade actually for the morning. And we were out of that trade. I want to say, let me see when I closed that trade out this morning. By 11:15, so 9:30. When did I get filled? Filled at 9:34 a.m. out at 11:15 for a 50% profit. I'll take that any day of the week. Okay. All right. So here we go. Let's get some comments here. Ernesto's here from Italy. Imran here from India. Prefer X. I'm going to jump over there. Says Zach. Okay, cool. Yeah, I mean, I'm streaming this right now on YouTube, on X, on LinkedIn, on Facebook. I'm streaming this on like 4 or 5 different platforms, so you can check me out at your convenience. But I appreciate the everyone watching, whether you're here live with me, leaving some comments, or watching the session afterwards when it's archived on my YouTube channel. Okay, but let's go into. We got a little current market review. Let's jump into anatomy of a trade. And I want to dissect, if you have some strategies for me, let me know. I'd like to kind of address these. These were brought up this week with my live sessions. I've got about 200, 250 people live every single morning. These were the most common requests. So last week I had some iron butterflies and some butterfly for some profit traps. I'll talk about those. Jade lizards, that's a little bit more creative. That is a combination. Like a lot of these are combination trades. So here's what I will say: a prerequisite for any combination trade is, can you use a simple call spread or put spread. If you understand like a basic debit spread, you understand a basic credit spread. And again, I have a video here that I will share. Check this out if you want to see like a strategy 101 where I talk about long calls, bullish spreads, long puts, bearish spreads. Okay, that's a great reference video that's inside my library as well. Just check out the video section. Um, See if that link will. I hope that link has an underscore at the end, and it does. Yep, that's right. So fast track to profitable trading. This is a like 2-hour session, I think, that just runs through um, a lot of great trading strategies. Okay, so if you want to get like the fundamentals, the prerequisites, this would be a great strategy session to watch. And then coming back into this, if you can get through a basic call option or a simple spread option, whether it's a call spread or put spread, all of these trades here are just combinations of them. Okay. So what I'd like to do is by default. So let's default to SPY today. Is that fair? You can type in a YES in the chat if that's fair. Let's just use SPY. It's super liquid. We've got super liquid tickers. The bid ask is really tight. You can get in and out within pennies, and you have expirations like literally every single day. So for duration, we'll go SPY. Duration is a preference, right? We can go from 0 DTE, which is same day, to leaps, which is 1+ years. And I mean, right now, if I look at an option chain on the SPY or SPX, I can go to the SPY, and I actually did this for my Project Options Edge. We sold some premium. It was out pretty far. I think it did either a January 27 or even a January 2028. Let me double check that in my Telegram group. So I'm going to go to Project Options Edge, 2027 for Google, 2028 for Costco, 2020. Oh my gosh, I went to 2026. That wasn't even that far out. So I went to the end of the next year for a 250 and 243 credit on SPYs and Qs. And I went 50% lower than all-time highs. So that was just because the VIX was elevated. I like to sell premium when the VIX is, above 20. It doesn't happen very often. When it is, I tend to sell some premium and deploy some capital. So anyway, there's a lot of ways to do it, but we'll say we'll focus, fairly near term. We'll use a lot of examples today on maybe a same day trade. I am pretty intense when it comes to trading 0 DTE, meaning 0 days to expiration. So I take a trade today, close a trade today, and I am trying to win the day. So today we had a nice winner on daily profit play. I haven't had my defense trades fill. I'm still going to let them fill. If price is going to get up to 67, 70, or 75, I may get filled on a butterfly, but it's probably not going to get filled today for SPX, which is okay. So we'll default to the SPY. So we have just an easy ticker to look at. We can talk through 0 day. We can talk out, maybe a couple of weeks or a month. We'll build out some trades. I'll keep my option strat platform handy. So option strat, so we can look at a variety of strategies. I mean, this also I understand is pretty intimidating for a lot of traders, right? If you look at this, you're like, build a trade. These are all of the different option strategies that you can consider trading. Okay. But like I said, they're really just combinations. It's just a call spread or a put spread or a combination that gives you some type of reward, some type of risk, unlimited profit, defined risk, defined profit, like it's capped upside, capped downside. There's a lot of ways to do it. And there's a lot of times you can choose. So, in essence, it's like you have an infinite amount of possibilities. It's really just a matter of your trading price and time. And if you get the area that need to be profitable, if price is above or below where you need it to be, you make money. If price is not, you lose money, and some trades have unlimited risk potential. If you go to the upside, you literally have unlimited risk to the upside. If you're, selling and prices go through that, nobody wants to do that. Most brokers won't even let traders do naked calls unless it's paired with something, or you're going to manage the stop loss. And then naked puts, the risk would be in a cash account. They're assuming that the price of the underlying could go to 0, and that would be your maximum risk, which again, actually taking on that risk in reality is not really the case. Like rarely, I mean, who has seen the indexes go to 0 in the last 50 years? Nobody, right? And so when I do a put, if I was going to sell a put on the SPY, let's go just an example. If I sell a put to January 2027, and I think that the 480 lows, I mean, this is crazy. January, it's like I could sell the 480 low. This is $1,000 trade. It's a $940 trade. But what this shows me is like, yes, the broker's willing to give me $9 in credit, but I mean, this is a 91% chance of profit. I mean, this trade is awesome. It's awesome. Fudge, like I kind of want to take this trade now that I see this type of premium. This is wild, man. 2027 is not that far away. Like we just kind of roll with this. It's like if the market doesn't take out these lows, let me see. I mean, maybe I can get this thing for $500. Let me see if I can do a ratio spread and get like a $500 winner here. Let me go spy. So how low can I go? Let me see where like the 7s and 6s are at. So if I do a 420 by 4, let's go 420 by 400. Okay. So I can get about $1,000 profit trap there. Pull in $4.63 of income. I mean, this is a good trade. So I guess I'm going to skip ahead a little bit. I'm going to start out with what I've had a lot of requests for in anatomy of trade, and a lot of requests for one of my services, which is Project Options Edge, and I trade a lot of ratio spreads. So if I built this trade out here on the SPY, I would buy the 410 put and I'd sell the 400. So give me 1 second here. This will be a sell. This one I would go to 2 contracts. Okay, so if I buy the 410, sell the 400, I get $4.60 plus cents of income. I know this trade is out 416 days. That's just over a year. Probability of profit is 98%. If I were to take ownership of the SPY, price would have to fall below $400, which means from current prices, $400 SPY, we'd have to be down over 40%. I'm not saying that we can't do that, but I'm saying it's highly unlikely. Okay. I think that's a pretty good looking trade. I really do. And I also have the cash here that if I wanted to deploy it, I don't mind getting this trade in as something where it's like, yeah, I'll take some ownership. So I'm going to take a trade. I'm going to take a trade right now. This is going to be a ratio spread. I'd like to kind of play around with the numbers here a little bit because I could also do this with let's do something like this. Let's go 420, 410, 400. I get a little bit more credit on this. Oh, maybe not, about the same. Strikes about the same, $10 profit trap. Now I get a $1,500 profit trap. 420. I mean, if I can get $400 on this trade, my break even would be all the way down to, I get a $400 income trade. My assignment price would be $390. That's over 40% off from current price. $390 assignment minus the $10 to $15 profit trap. I'd have a $380 to $375 break even. And the S&P is down 45%. I don't think that's going to happen. I mean, could it happen? Sure. But I'm also taking like a lowering of my delta because of this option here. This is a 9 delta. If I add in the long put at 420, it reduces it from a 9 delta to a 3.5. So I have a $15 profit trap as well as the 390 naked put. We get this trade in for 405 and see if this will fill. I like this trade. This is going Project Options Edge if I get this thing filled. So 405, let's try it out. 405 is pending. I'm going to try to penny this thing down until I get filled. So I'll post this trade in the chat if you're interested. 404 right at the mid price. Hopefully we get filled over $4. $402, $401. Come on, SPY. All right, just got filled at $4. So this is going in officially for Project Options Edge. New trade, SPY, 115.27 expiration. I know that's out for over a year. I'm okay with that. I'll show also, I don't mind making the assignment. If I get assigned at 390, I'm happy to own the shares at 44% off of current price and probably over a 50% correction from all-time highs. So a buy 420. So everyone's going to get a free trade out of me today, and that was going for my Project Options Edge service. So I'm buying the 420 put. selling the 405, and selling the 390. And I collected $4 credit filled. This is a 111 or a, it's kind of a modified ratio spread. 99% probability of profit. Assignment risk about 4% chance of assignment. I'm okay owning SPY if price is less than 390 at expiration. I have the 420 by 405 as a $15 profit trap to also offer more net profit and lower my cost basis. If assigned, my break-even price on the shares equals, I'll take the 390 assignment. I'll build this trade out in option strat so you can see the visuals. 390 minus 15 minus 4. I own shares at 371. Okay, and 371 from current price. 371 from here is about 44.8% lower. 44.8% lower than current price. And 371 from all-time highs. 371 would be around 46% from recent all-time highs. Okay, so now I'm going to take that trade for my margin accounts. And I'm curious what type of spread I can get if I did like the 390 by 340. $1.50. I mean, that's a little income trade. I'll wait. So I'm going to put this on my margin accounts. So let me work through this for a second, and then we'll build this out in option strat. Filled for 401. Okay, just getting these trades in right now. Okay. Keep going here. Let's go 36. All right, just give me a few minutes here to get these trades in. I'll get this updated and sent out. So it's officially been posted in my Telegram for Project Options Edge. I think this got filled as well. Yes. Okay, a couple more here, and then we'll get it built in option strat. Those are all filled. 2 more accounts. Okay. So that trade is in for $4. If I'm going to manage this trade, I'm probably going to take this trade when it's showing about $325 to $350 profit, depending on how long that takes. So this trade's out, 416 days. If by the halfway point of next year, or earlier, I mean, if we rip up to, SPY at 750 or 800 SPY, this trade is going to probably show over $300 profit. I don't have to sit and wait for expiration if I'm up, majority of this profit. So ideally, with a fill at $4 credit, if I get out of this thing for like 50 cents debit, I pull 350. So let's say I make $350 out of the 400 max credit. I'm making 87.5% of that max credit. I'll get out of the trade. It's way more capital efficient to get that buying power back and redeploy that capital if I'm in most of the profit. So a lot of my, Project Options Edge trade, if I'm up like 80, 85, 90+% of my credit on some of those premium selling trades that I do, I'm going to take the profit and be more capital efficient and deploy it elsewhere. So I like that kind of 80, 85, 90+%. right? And that way I can save ourselves some time. We can have that capital efficiency and we can redeploy on fresh trades. So let me post this a couple of spots here. Tracker. This is officially for Project Options Edge, SPY. So a 1/15/27 expiration. So a 4/20, 405. Shoot, 405 and a 390. And the assignment break even with a $4 credit would be 390 minus 15 minus 4, 371. Okay, so there's that. Get this trade posted. This is an index trade. All right. If you don't want to own SPY shares, manage the 390 put for a 200 to 300% stop loss. So filled at, that trade is around 467. 467 credit. You can consider closing. So let's go 467 credit. 467. So that's a 100. That's a 200. So 1401 to 1868. 1401 to 1868 debit. And that way the trade is pretty manageable. So if you don't like the idea of owning, if you don't have the cash to own this stuff, but if you're on a margin account, it shouldn't take up a lot of buying power. But if you don't have the cash to own, or you don't want to own, you can just manage the put side. So that 467, if it's a 300% stop loss, you're going to lose. If you lose about $1,000 on the trade. So you can make 400. You're risking about 1,000 on that stop loss. I don't mind taking the shares and owning it, because if I could own the SPY at 45% lower than current price, I will own the SPY. I can always repair that trade. I've got plenty of cash to do that. Okay. All right. Yep. So if this strategy, but what if you don't want to use that much buying power? Then you can build it out this way. If you don't want to use that much buying power, let's do a modified version of this. If I buy the 420, sell the 405, sell the 390, what I'm going to do here is, notice how this is like a 15 wide profit trap. This is a debit spread. So I can make $1,500 if prices below 405. My 390 is in this trade that I just took. This 390 is a naked put. Okay. So what I'm going to do is go wider than this $15. So what I'll do is I'm going to go about 30 wide and see what this thing does as an income trade. Okay. So right now, if I went 30 wide, I can have a $15 profit trap, and I can tighten this up too. I can maybe go $1,000 profit trap. Again, like, this is defined risk. I could still get $50 income on the trade. If I'm willing to go a little bit wider, I get 80 cents on the trade. I go a little bit wider, 40. I mean, I can get $100 on the trade. Now I'm making $4 on my trade. Okay. But look at the buying power here. If I do this on an IRA account, let me find one of these IRA accounts. If I do this on an IRA account, my buying power is going to be dramatically less. So let's go here. This is a IRA account. So if I do a defined risk trade for $100 credit, I still have $1,000 profit trap. I'm only taking up, this requires about $3,900 in buying power. Now, granted, let's just take 39. I make $105 out of $3,900. I mean, I'm getting a 2.7% return on that buy power. I mean, that's not the greatest, but there's a 99% chance of profit. That's a pretty safe income trade. I'm allocating $3,800. I mean, if I had 20, 25K, 30K, I could take this trade. Would I stack up 10 of these trades, 20 of these trades? No, that's way too much buying power. But for this trade with such a high probability, and we've got an elevated VIX at 20, it's just a good opportunity to take advantage of selling some premium. But this would be defined risk. This would cap the downside. And, I still I really wouldn't want to lose on the trade. Like, even for my IRA accounts, I have enough cash in my IRA accounts that if I were to own 100 shares of the SPY, I'd still own the SPY, you know, but you don't have to because you can simply just manage the put side of the trade as well and keep this a little bit more risk defined. So that's how I would modify it. So let's do this. Let's build the trade out. I'll show you what it looks like on option strat. Technically, I just did a ratio spread, but I'm just going to modify it a little bit. So let's go SPX. I did January of 2027. So, yep, this one here. They're not giving me the weekly expiration, but that's okay. I will now take it's a SPY trade. SPY trade, January of 2027. I'm going all the way down here to a 420. So I'm buying a 420. I'm going to reduce this one to a one contract. So that's buy the 420, sell the 405, and then sell the 390. So this is the trade that I just took right here. Okay. So is there risk? Yes. If the S&P were to go to zero, then I'm risking, the assignment price at 371. I take on any risk below 371. Okay. That's my break even price. The probability of that happening is about 3%. According to current volatility, which is over 20, it's pretty difficult to have a sustainably high VIX for that long. Especially if we chop sideways through this year, we make all-time highs in 2026 through the first half of the year, whatever this thing looks like. If I own the SPY 45% lower, I'm happy to start building a position there, but that's just me. Okay. So this is what the trade looks like. If price stays exactly where it is, all I need is time, because right now we're starting the trade. There is, over 400 days in the trade. Let's just take half of this time. If I go out 200 days, okay, let's go about 200 days left in the trade. I want to show you exactly where we're at. If we are right now, if the SPY is still trading around 670, and I'm halfway through the year, I'm in, let's say June. This is June of 2026. I'm going to make most of my profit if price is around 650 or higher. I'm going to be sitting up about $350 to potentially 350 out of $400, that's almost max profit. That's 87% of my profit. So if price is roughly where we are right now in June of next year, I'm going to close this trade out at the halfway point and pull in most of that credit. Okay. As time goes on, you can see that the credit for me gets higher and higher because the out of the money percentage is as high as it can be. And time is just continuing to work in my favor. So the longer this trade goes, the more max profit I can get. And even I give myself some forgiveness here. But the profit trap, which is worth $1,500 in that trade, the profit trap will not fill until the week of expiration or the day of expiration. You want this thing to give you a $1,500 profit trap, then you want to see price in that zone, like literally the day before or the day of expiration. See how that profit trap fills up? We're talking like, days remaining. Look at this thing. 20 days remaining. I'm in the profit trap, right? Let's go 10 days remaining. That profit trap is getting bigger and bigger and bigger. And the final few days, profit trap is offering up max profit. So the profit trap, I'm giving myself like a 10, 15, 20 day window here, which is kind of nice. And that's also a massive margin for error. Like literally the market can fall 40+% and we're not really taking on any major risk. Okay. Does that setup make sense? That's a ratio spread. It's a little bit more of a combination because I'm doing a 1-1-1, meaning I'm buying the 420, selling the 405, and then selling the 390. So the 390 is a naked put. The 405 and the 420 make up for a debit spread. The debit spread of this is the 420 by 405. That gives me this profit trap. So if I zoom in on this, let me see if I can zoom in and make this a little bit easier to read. Okay. Can I zoom in here? Not really. All right. So this is the 420. This is the 405. This is the 390. And my risk would be 371. So I just wanted you to see, like, these are the break-even levels. 420 is where my profit trap starts. 405, if we're below 405, my profit trap is maxed out at $15. This is my 390 naked put on that trade. Okay, and then right here, my break-even price is 371. And the reason I get 371 is I take my $15 minus my, so if we have a 390 minus $15 from the 420 by 405, that's a $15 profit trap. And then I take the $4 on the credit. Okay, so 390 minus 15 minus 4 is 371 is my break-even price. So as long as price, yeah, if you're doing a naked put, it's going to take some cash. Now that's cash versus margin. I'm taking this in margin accounts, which only requires about $3,000 in margin. So I'm a much heavier trader when it comes to deploying option trades with margin versus cash. If I do cash, I'm gonna manage probably 50% of that profit if I'm willing to take. I mean, a naked put in a cash account is still a great trade, but it is going to tie up a lot of cash. So, trades like this, I tend to deploy in my margin accounts because I can work that capital a lot more aggressively. The probability assignment is 3%. So that is what the unfortunate thing is about having and look, a cash account's great if it's for an IRA and you have no taxes. Like obviously that's a great way to grow your wealth, but when you don't have the leverage or the buying power, you got to make good decisions. So I tend to stick with risk defined trades. Now I could. So William's saying, 38K in cash. You can also add that defined risk leg to it and turn this into like a $3,000 to $4,000 cash trade. And that way you're going to get about $100 in profit. So $100, still the same, 99% chance of profit. You're going to get $100 to $105 of income, and you're only wrapping up about $3,800 in cash. Okay. So before I build that out, can everyone give me a wire yes in the chat? Like, does this trade make sense? So all we need price to do is stay exactly where it is, go up to all-time highs. It can fall 40% before we take on any real heat. Okay. So that's why I like to trade. And, I tend to look at these things pretty aggressively when the VIX is somewhat elevated. We're down to 19. We had a 28 plus VIX last week. We're down to 19. That's a pretty good vol crush, which, isn't a huge surprise because we had such a crazy day last Thursday. Okay. So what I'll do now is let me add in, let's add another leg to this. Let's add like the 390 by 330. So I'll add a buy put and I'll make this a risk defined trade. Now we can go 330. Check this difference out. Okay. I still have my profit trap for $1,500. I still have $1 plus credit, but now my buying power is reduced. Now, yes, there is risk on this trade. Okay. I'm tying up a little more, maybe go like 340. Okay. $80 to $85 of income, max risk, $3,400. Probability of profit still 99%. But it is one way to, make a little income trade, not tie up a ton of capital. And it's still risk. And for me, if I took this trade on my IRA accounts, I would want to have enough cash to own the shares. Okay. To take this a step further. Okay. Chris, love to have an option video. It's a great question. Here is I shared the link earlier, but I'll post it again. Here is a great beginner's guide to options trading. So Sam, if you had that question, I'm just going to post this in the chat. When you have a moment, watch this video. We did this right here on YouTube. I just posted that video. So check out that video. That is some very, very basic option stuff. If you'd also like some basic option stuff, I do have a couple of like foundational courses. This practical options quick guide is $27. Okay. It's a great starting point to get people, interested, informed, and trading options with a much faster learning curve and applying it to price and time. That's all we're trading. So I'll copy this link. This is practical options quick guide. There's a link for that. If you'd like to upgrade to full, I've got the full course available. That's the quick guide is 4 videos. The full course is 11 videos. The quick guide is 30-page PDF. The full course is 72-page PDF. I literally built both of these out for my nephews at the time who were, they were 15 and 18, asking me about Bitcoin, asking me about trading options, asking me about GameStop. I was like, I appreciate, these, kids want to learn how to trade. My whole career would have been different if I started trading, as I've been trading the last 15 plus years, like full time. If I did this, as I was going into college, I think I would have been on a very different trajectory versus, going in the golf business and traveling. I mean, it was fine. It was a fun journey of traveling the world and, playing and teaching and whatnot. But when I fell back into finance, I've fallen in love with it, since day one. It's just I wanted to make sure I built up enough capital in a nest egg to have money to trade. It's difficult to take, $5,000 and try to make it into $1,000,000. But if you can have enough money to trade with 25K or 50K or 100K, you can start really grinding and making some pretty good gains. And on top of that, I mean, even like Charlie Munger said that 100K is like the hardest to get, but once you're there, it's like the averages and returns, the compounding nature of that, it just grows that much faster. Like you can make more money as your account compounds and grows. Like that is the eighth one of the world. So anyway, I mean, I know 100K is not easy for everybody, but once you are there, there's a lot of good things you can do with it. Like you can literally start talking about, supplementing your income, um, replacing your income. It's just a process. I mean, trading is a game of wins and losses, and the markets, they don't care whether you make millions of dollars. They don't care if you lose millions of dollars. There are lots of ways to do it right. There are lots of ways to do it wrong. And somehow we're just trying to figure out how to do it where we're understanding what we do and making good decisions and trading probabilities. So anyway, hopefully that helps, Sam. If you want to check out that couple of those links. So there's YouTube videos on just getting started with some option stuff and some of these live sessions I've done. And also, if you want like the quick guide, that $27 quick course, maybe check it out, and hopefully that helps kind of wet the whistle on getting a really accelerated learning curve. Okay. All right. Anything on this trade? So I posted that officially for Project Options Edge. It's in my Pulver alerts. It's in my personal tracker. Good, good, good. Okay, I'll add that in here for the Project Options Edge. This is a January 15th, 27. Okay, so that trade is in. I like it. Okay, so I definitely skipped ahead, but I've had a lot of requests on ratio spreads, so I just tossed one out there. I like the trade a lot. I'm giving myself a wide margin for error. This is probably the most comfortable I feel right now in this environment, which is I don't know what it is about this current market, but I am, equally as excited as I am scared. Meaning, like, I think this market could continue to go sideways and make this very challenging to navigate. And the market may not have any direction. You know, I mean, 2015 and 2016, we had a peak to trough of about 20%. And we did that several times over a 2-year period. Okay. Right now, if this market goes sideways for 5% or goes sideways for 10%, I don't think that is out of the I don't think that's out of the realm of possibilities. That we have not really had sideways anything. It's either this market is, look out below or rip to the moon. And I just wonder if we enter a phase where consolidation is going to happen. And it just means that it's difficult for, US earnings to continue to outperform and outpace earnings expectations. Um, and so if we have like a stall, it's like, yeah, we could have sideways price action. But I think making money in sideways is great. In fact, it's one of the many situations and environments that I think real traders make a lot of money because you can sell covered calls, you can sell puts, you can do income based trades, and you don't need a lot of direction. And sometimes like no direction is a very profitable strategy. So okay, let's do this. I'm just going to put let's do like a checkbox or something here. I'll asterisk it when we've kind of done it. So let me go into a bit more detail on the ratio spread. Okay, ratio spread is um, it is a 1-2 combo where you buy a put and sell 2 puts. The sell 2 puts at a lower strike. Okay. So it's a 1-2 combo. So you can go buy a put, sell 2 puts. And what that will create is the buy one and sell one equals a profit trap. And the additional sell one equals a naked put. So the profit trap helps lower the cost basis if assigned and helps lower the delta exposure. and reduce volatility. Okay, you can do this either direction. There is a trade called, I don't know if this is the technical name for it, but I've been seeing it called the Batman. Let's say, let me ask you if this is fair. If I go out to 400 on the SPY, let's go 400 on the SPY. Okay, I'm going to build out a ratio spread trade. Check this out. Let's go brand new trades. I'm going to go 420. Let's just do this. Let's do a 410 by 390. Get rid of this. So remove this one. 410 by 390. Let's make this one a 2. Remove this trade. There. So if I buy the 410 and sell 2 at the 390, the 410 and 390 is a profit trap, which is what gives me this peak. And then the 390 with the second contract is my naked put. Now, is it fair to say, okay, look, this market could go down 40% and I can still keep, like, I don't want it to go down 40%. Nobody does. But the market has about 40% breathing room to the downside until I have any type of assignment risk here. Okay. Now, to do this equally, I'm going to say, you know what? Let's go up 40%. Let's be fair and say, if I'm going to go out to the end of, January 2027, do we think that next year's trading, the market could be up 40%? We've had a 20+% year in 2023, a 20+% year in 2024. We're hanging in there with like a 12, 13% gain in 2025. Is it possible that we have a 40% rally in an index in 2026? I would think that's improbable. Now, I can look at the option chain and kind of figure out where those probabilities are at. So let's look at the option chain because I'll build out a little fancy ratio spread here, and let's see what it is. So if I go, what is about 40% higher? So 0.40 times 673. Okay, so up 269 points. That would be a 673. Crap. So 0.40 times 673. So that's up to, I'll just do a 950. So if I go up to a 950 strike, right now a 950 strike is a 2 delta. If I buy the 950 and let's say sell the 975 with 2 contracts. Okay. Now this is not pulling in a lot of premium. I will say that. If I go, 2 delta is like extremely, extremely low. But this trade offers me a $500 profit trap and 60 cents credit. If we want to lower the strikes a little bit, let's go by delta. Let's do like a 5 delta here. I think we can get a little bit more premium. Let's go 900. $1,000 profit trap. What's that put me up? If we go from 900 minus 673. If the market next year produces a 33.7% gain to the upside, then this trade would be at risk. Okay. But let me build this trade at 900 by 910 and just watch what this does. So I'll add in a buy call and a sell call, and I'll drag this all the way up here to the 900. So 900 by 910. There. Okay. Let's just make it even. Let's go 915. So now I have a profit trap either way. This is kind of a crazy looking trade, but what I'm doing is essentially doing an entire range trade. This would help me generate about $500 of credit. And what's funny is most of that credit's on the put side right now, not the call side. But the reality is, this is why the saying is bulls climb stairs. Okay. Bulls climb stairs and bears jump out of windows. So volatility to the downside is typically way more violent, way faster versus the slow, steady grind and melt up of positive drift that we typically see in the indexes. So what this trade would be is this kind of goes by the name of a Batman trade because you can see the pointy ears on the left and right side of the trade. And this is where price actually is in the middle. So all I'm doing is like looking at this trade. If price cannot go, what I say this upside was, that upside would be 33. So if we cannot go 33.7% and we cannot go 44% lower, then I can generate pretty safely $485 of profit. Okay, so what's my loss? Well, obviously, if I'm doing it naked, like a naked call, and I'm doing a naked put, I have infinite risk because to the upside, this can go to infinity, and this is what the options market assumes. And to the downside, this can go to zero. So infinity over here and zero, which means, this is a very difficult trade to take on a cash account. On a margin account, you can just manage this with, maybe three, four, $5,000 of buying power. Okay. But the probability of profit, I can build this thing out. This probability of profit is about 90%. Okay. Because it's taken into consideration that, the market obviously can go up, the market can go down. And so I'm, taking the difference between the two. Realistically, I have about a 99% chance profit on the put side. And this is showing me that I probably have like an 80 to 85% chance profit on the call side. So that's why that balances out to be about an 89 to 90%, probability of profit going both ways. So this is a bit overkill, but I want to show like, look, if I want to take this big, wide, huge range trade, if price can't get to, 915 or 920 next year and price can't fall to 400 next year, I can generate $500, you know? So it's fun. Like this to me is like a huge net, but it's a huge sideways market. And this gives price room to go up. This gives price room to go down. This price can go nowhere at all. This price can go up 20%. We can have a fantastic year, go up 20%, and our trade is not going to be threatened. And so we'll have a lot of money here quickly and we'll take on some risk, through the trade. But by the time we get to expiration, I don't think we're going to be 33% higher. If we are, that's why I wouldn't call the top. If we're down here, I would gladly take ownership and I'd repair it because the goal is we're going to try to get to all-time highs again eventually. So I'll take the discount, I'll repair the trade, and I'll flip it for income. Okay. Thanks, Sam. I appreciate that. How is it called in Thinkorswim? Just do a custom trade there, Ernesto. If you want to build it in Thinkorswim, you can do a custom trade. So I'll go to my Thinkorswim. Let me go Thinkorswim web. I personally like the web platform a little bit better. Let's go this trade here. I'll go Thinkorswim. Give me a second. So I built out a 420, 405, 390. Let's go to SPX. So this is Thinkorswim web. You can plus minus this thing like Iron Condor, change the strategy type to whatever. I mean, there's Iron Condors, there's verticals, there's calendars. It looks like it's a little bit limited compared to what you see on the Thinkorswim desktop platform. But I'll just build the trade out. Watch. If I go SPX option chain, we decided to go to January of 2027. Yes. So here's my January 15th, 2027. Select the expiration. Now I find my strikes. We did SPY. Sorry. So I'll do SPY. So SPY into January 2027. Got to find my strikes here down to the 400s. There we go. So I bought the 420 put. So the 420 put I buy. The 405 I sell. The 390 I sell. So if I did this for one contract, this is showing about a 405 fill. Cool. So I got $4.01 when I took the trade. It's up to, this is showing a mid price around 405. That's the trade. I buy the 420, I sell the 405, I sell the 390. If I put in review, this is going to show that it is taking out $39,000. This particular account is a cash account. I actually don't have the buying power on this thing. Option buying power 26K. So this one I'd have to go more risk defined. So what I can add to this is let's close this down. Let's go 420, 405, 390, and then do like that 350 or so. Let's move that 350 down to 330. Now we get a buck. Now the trade requires about buy a put. There we go. There. Now it takes about $4,300 of buying power. Now I can afford to take the trade if I want to. So I make $100. It's about a 2.6, 2.7% return on that risk, but about a 99% chance profit on the trade. So whether you want to use risk defined or you have the margin to do a naked put, I'm trading probabilities. I don't think this trade is going to fall 44%. If it does, I'm going to own the shares of the SPY. I'm going to repair it for several $1,000s in gains. That's the nice thing about having margin is I'm, I don't think the market's going to fall that much. If it does, I'll own it and I'll flip it. Okay. All right. Good stuff. Does that help on the web platform? So I mean, anytime I'm trading Thinkorswim, I usually just build the trade as a custom versus trying to choose their default strategies. Okay. All right. So I mean, that was fun. Like that's ratio spread. It's a one. I'll put a 1-2 combo so people don't confuse that for like a half combo. So it's a 1-2 combo, meaning you're gonna buy a put and then sell two puts lower, and one of those serves as like a naked put, and you have like a little profit trap. If you're doing it on the call side, you buy a call and then you sell two calls above. That creates a profit trap and a naked call. I don't like to do naked calls. I rarely do anything with naked calls unless it's some type of strangle. Because I think the one thing that you never want to get in front of is, a rocket ship type blast off move, which we've seen plenty of in 2025. Look, if you try to short Nvidia at all this year, good luck. I mean, if you're shorting Google, good luck. It's like it's just not worth it. The upside, I mean, this market can run so much farther and so much hotter than you ever think it will. I mean, I remember people calling the top on Palantir last year at like, $100. It ripped up to 190. Calling the top on Carvana, it's like I just don't think it's worth shorting anything. If you want to short it, be a hedger. Hedge the market, don't short the market. As they say, bulls and bears make money, pigs get slaughtered. So don't overtrade. Give this market a chance to just show its confirmation, follow price action. The house edge is to be bullish. Longer term, if you're trading bullish, you're probably going to make money in the next 5, 10, 15, 20 year horizon. It's hard not to. Okay. All right. So that's a ratio spread. I know we spent some time in there. We'll have some fun with this. We'll take this all the way. I don't care if we go like 2 hours today, whatever. This is a fun segment. Okay. All right, good stuff there. All right, let's go to another strategy. We think we covered some ratio spreads, and I know this stuff is kind of basic. If you'd like to see a ratio spread, Option Strat is a free website. You can build out any trade you want. If you want to build out a ratio spread, you can see in that bottom right hand corner here the put ratio spread. So I personally like to do a put ratio spread where I pull in credit, and you can see that sometimes they'll build it out where you have like a tail that's a small debit, you have a profit trap. I like to do it where I have a credit up front. So my ratio spreads for everything I've done in Project Options Edge. This is a trade I just took. SPY for $4 credit. Okay. Google for $1.65 credit. Costco for $4.65 credit. Q's for $2.43 credit, $2.50 credit. This one for Netflix, $1.18 credit. $2.17 credit on Amazon. This is Nvidia. We did this one. We closed this out for profit for about $320. Q's $1 credit. SPY's $1.05. Target $1.90. So I do a lot of my ratio spreads with credit. So this is kind of cool. Just get a visual of all these crazy fancy strategies. Long call, long put, the most basic. I've done this before in these sessions. Anytime you're trading long calls or long puts, here is my rule of thumb. Whatever timeline you use, if you want to buy a 30-day call option, I saw somebody type in, swing trading 4 to 6 weeks. If you go out 4 weeks for a call option, you want to manage that call option at about 2 weeks. So rule of thumb is whether you're a long put or a long call directional, all right, you are going to lower your volatility and reduce the size of your losses significantly, like probably reducing your volatility by about 50% if you just manage win, lose, or draw. If you just manage those long options at the halfway point. That is tried and true and tested for 30 plus years. That's a Tasty Trade 101 type thing. If you've seen their segments on Tasty Live, the halfway point helps reduce portfolio volatility. So if you're out 30 days, 4 weeks, right? 30 days of trading, manage it at 15 days, manage it at 14 days. Okay. You go out 45 days, manage it at 20 to 23 days. You go out 60 days, manage it at 30 days. You go out 100 and some days, manage it at the halfway point. Even if it's a small loss, it's better than taking a full loss. Okay. So you can still retain some time value, which will reduce the size of your losses. And if price is moving in your favor, you're going to make money. You basically reduce what happens in time decay is every trade in time for options look the exact same. Every trade in options on options time decay looks the same. They all look like this. This is your starting point, and then I'll put like a little checkered flag down here for your finish line. Okay, excuse my art. Okay, there's my checkered flag. So start to finish. So you start out here, and this is what every option trade looks like. So about the halfway point, that is before the waterfall of time decay kicks in. So this is time. Okay, type in a wire yes in the chat if this makes sense. So whether you are buying options or you are selling options, when you're buying options, time is working against you. When you are selling options, time is working for you. Okay. So if you're buying options, you want the price of the asset. If I buy a call, okay, if I buy a call, I want my trade to be profitable by about the halfway point or earlier. Okay. So this is your window. If you're long an option, you want to get paid in this environment. If you make a small portion of profit here, it's better to keep it. If you're at a small risk, it's better to take the small loss, because as soon as you get past this halfway point, time gets more aggressive against you, and you don't get nearly the bang for your buck when it comes to the deltas in the options chain, which is like for every dollar that the asset moves, you're getting less and less of that put into your option trade because time is no longer helping you, right? Time isn't hurting as badly until you get to that halfway point, and then after that, it starts to cascade to the downside. So, best rule of thumb for me, if your long calls or your long puts, is managed at the halfway point. Okay. And then people ask me, well, Chris, if I buy a call, should I buy at the money? Should I buy out of the money? Should I buy in the money? If you want to take away some of the power of time, buy in the money. So if I wanted to buy an in the money call, I mean, right now the SPY is trading at 673. Okay. If I buy a SPY, let's say a 650, okay, there's a $23 value built into this trade. I want to see what that's going to cost me. I'm just curious. It's probably going to be expensive, but my break even will be a little bit lower as far as the actual asset value. So I'll just show this as a comparison. So before I move on and go into the option chain, does that rule of thumb make sense? For everyone that likes to buy calls and buy puts, my best rule of thumb, 30 years plus data of doing this, manage at the halfway point. Your volatility will thank you, your losses will be smaller, and your winners, if you get runners, you have unlimited profit potential, but you don't want to let time be a constant plaguing factor in your option trading. So don't let time hurt you as badly. Don't try to hold this thing to expiration, because the reality is 70 to 90+% of all options, if held to expiration, will expire worthless. And so when you are long an option, you obviously don't want that to expire worthless. When you're selling an option, yes, you want that to expire worthless. That's how you make money in a selling option environment. But when you're buying an option, you want that option to gain in value. Okay. So what I want to show is comparing like a, in the money, out of the money, at the money, which again, all this stuff is talked about in my practical options course. I think that, the key terminologies, things like that, it's in that course. So the $27 quick guide of the full course. Let's go into the option chain. Let's talk SPY. Who wants to buy a SPY? Let's say to like, I'm just throwing it out there. Let's say May of next year. We give ourselves a nice little rally, right? Let's say we give enough time where December and January, we maybe have some weakness coming into like February. I have no idea, right? I'm pretty bullish, honestly, through the first half of the year in 2026. So let's go to May. Let's go May of 2026. And if I were to buy an option right now at 670, I'll buy an at the money at 673. Okay. So the broker says you got to take this trade for 39.22. If I buy a 673 call option and I add 39.22 to that, my break-even price is $712. Okay. That's not nothing. Like I need technically by price, it's like, yes, I have time. I have 185 days. When should I manage this trade? By about 90 days. If I try to hold this trade 150 days, 160 days, 170 days, I need price to be up above 712 for me just to break even. And that is a very difficult thing to do. Let's take 712 minus current price of 673. We need price to go up 5.8% over the next 185 days in order for us just to cover the cost of our trade. I'm not saying that we can't do that, but if we go sideways for 3 months, it's going to be a very difficult environment for us to make money. Okay? So if we go up from 673 back to 700, you can probably take partial profit on this trade. And because you have time, because you have, price and direction going your way, you're going to make money on the trade. It's just going to be a small chunk of profit. So my break even is what's this? 39.22. So 39.22 plus 673. So that would be a 712. I'm going to write this down. 712.22 break even. And that's an at the money. Okay. So if I just buy the 673 call, it's an at the money trade. If I go out of the money, let's say that I think, all right, well, I don't want to spend that much money. I think the S&P can go to 7,000. So let's take the same expiration. Let's buy a 700 call. Okay. If I buy a 700 call, I'm saving myself. It was 39.22. All right. So if I do a 700 call, the broker says you got to pay $23.54. That's $2,354. Now that's way cheaper than spending $3,900. But now my break even is 723. I take my 700 call plus the 23.54. Now my break even is 723.54. I need price to technically be at 723.54 by expiration in order for me to make money, which also means I need a bigger percent move. So this would be my break even minus 673. Now I need price to go up 7.5%. So I needed a 5.8% move here. If I go out of the money, I need 7.5%. That's a 700 call. That would be a 723.54. That's an out of the money, and it's 23.54. Okay, so I need price to go up 7.5% just to cover my break even. I know. I'm explaining, Stephen. I would never take these trades ever. These are terrible trades. What I'm trying to show you is this is why people that buy call options lose a lot, because they just waste money, not realizing like, oh my gosh, I need a 6% move to make money. I need a 7% move. Yes, in an index, right? Generally, if you're buying call options on a stock, stocks have the ability to move way more to the upside or downside than indexes. So like buying SPY and buying puts, buying calls, buying puts on SPY or Qs, very difficult because it's such a liquid market that you've got market makers and efficiencies that are always in those indexes. And so it's better to be a market maker. It's better to be like trading like a market maker. But in stocks, sure, a call option, it's efficiently priced, but markets in individual stocks can surprise to the upside or downside a lot more. There's way more volatility in an individual stock price. So, if you like buying options, individual stocks is a much better way to do it. So, but anyway, it's the idea of understanding what strike I'm taking, what my break even is, how far price has to actually move. So this is a terrible trade. Now, if I went in the money, it's going to be more expensive. So we're trading at 673. Let's do like a 650. Okay, this is a 62 delta. It's expensive. Okay, but I want to show you what the break even price is. So 650 is an in the money. I'll do like a 62 delta. Sometimes there's a rule of thumb, like a 70 delta is a great price to start with. A 90 delta is a great price to start with. It's super expensive, but you basically take away a lot of the time premium, which that means it hurts you less as time goes on. And I'll do both. Let's do like I'll fudge it. Let's just do the 70 delta. This is really deep and it's going to be pretty expensive, but I'll show you. Let's do a 70 delta. So 70 delta, this costs an arm and a leg, but watch the break even price now. If I do a 70 delta, that would be a 623 plus 76.42. Now my break even is 699. This is my lowest break even that I've had so far, but it's expensive. So this would be a 623. This is in the money. This is a 70 delta, 76.32. I'll write this stuff down in the notepad in just a second. Now I require, so 699 minus 673. Now I need price to move about 3.9%. Okay. I need price to move 3.9% for me to break even on the trade by expiration. That's a little bit more achievable. right? And I'm also trading a much higher delta. So if price does go higher, I'm getting about 70 cents on the dollar. So for every dollar that the S&P goes up, I'm going to get about 70 cents of profit on my option trade. So if we go up, let's say that the S&P does get to, let's say it gets to 700. That's a $27 move. $27 move at a 70 delta that will continue to gain in delta. I'm going to get about $27 move at a 70 delta. That's $19 of value gain, and probably more because we have some time in this trade. If I make $18.90 out of a 76.31 debit, that's about a 25% return on my option trade. And what does price have to do? If price can get to 700, I'll make some profit. Really good profit. And you obviously want that to happen about 90 days from now. That's going to be a great trade. But it's expensive, right? I don't want to fork over. I mean, if I'm wrong, I'm going to lose $7,600. So it's not cheap, which is why I take mostly spreads versus just this. Now let's do one more. Let's go really deep in the money call. I'll do a 90 delta. This is going to be ridiculously expensive. Okay, I'll do a 90 delta, which is all the way down here at 4. We'll do the 485. Good Lord, this is going to cost 20 grand. But your break even, this is your lowest break even. So 485 plus 200.70, that's so expensive. 685. So if I did 685 break even, that's a 90 delta. That's an in the money 90 delta via 685. 78 minus the 673. I need price to go up 1.8%. But granted, it is expensive. This is crazy expensive. Okay. However, if I put $20,000 on the line, that's still cheaper than owning shares. If I were to own shares at 673, I'm in for $67,000 in capital. If I buy this deep in the money call option, it's 20 grand. So it's still a third of the price. But that's still an expensive trade because in an option trade, you can still lose. If you're trading price and time and you're wrong, you're gonna fork over 20 grand, which is not fun. Okay, but the underlying has to move about 1.9% for you to make money. And if we go, and I'll do the same thing. This is a 90 delta. Let's say that price goes from 673 up to 700. Okay, so if I go from 673. 700 minus 673 is a $27 move at a 90 delta. I'm getting 2430. 2430 divided by the 200. I'm getting about 12% return on that deep in the money call option. Not a bad trade. My break even price would be 685 versus my break even. So this is what's kind of crazy. I'll just add another piece here. So we're doing like long calls at the money, out of the money, and a 70 delta in the money, and a 90 delta in the money. Okay, so the trade-off is most expensive, but lowest break-even price. And, our example, we had about a 12% ROI with our price target. Okay. If we had a 70 delta, this is, second most expensive, second lowest break even, and about a 24% return with our price target. It's not a surprise that the 70 delta is talked about a lot. You hear Tasty Live talk about it with a zebra trade. A lot of people that talk about buying call options, Smarter Money does like a 70 delta. Just because it's that balance of not paying too much for it, having a pretty good return on investment, and not overpaying for those premiums. Out of the money is going to be the cheapest but highest break-even price and needs price to move the most and the fastest. That's what's difficult. Even though it's cheap to buy an out-of-the-money call, the price has to move aggressively and fast in order for you to get paid. At the money is, fair, but still second highest break-even price. Needs price to move quickly. Okay. So when you're long an option, when you're long or when you're buying calls and puts, my rule of thumb is manage at the halfway point of expiration. So let's say, 60 days to expiration, manage, win, lose, break even at 30 days. If you're 90 days to expiration, manage, win, lose, break even at 45 days. You get it. 120 days, manage, win, lose, break even at 60 days. Okay. A lot of traders like leaps and they go 365 days, manage around 180 days. Okay. This will help reduce losses, reduce portfolio risk, and volatility. Okay. And also you maintain helpful time premium, which isn't the case. As soon as you cross that halfway point, time is really working aggressively against you. So it's okay to take small losses. You'll save a ton of money in just not taking full losses. Because once you get over that halfway point, if you're at the halfway or 2/3, it's very difficult for time to be your friend. Okay. Give me some wise yeses and clears in the chat if this makes sense. Let's see here. Look at the link above for options. Okay, good. Yep. So thanks for putting that in, William. Good comments there. You do this with waterfall income strategy. I have a strategy 1, which is a debit or credit spread, and I have a strategy 2, which is a combo spread. It's technically it's called a put condor. That's my strategy 2. I do that a lot for waterfall income. The trade we just took this last week, I did a trade on SPX. I think we went out to January 16th. January 16th. I'm going to build out a put condor. Where did that go? This would be not short put condor. I want to go long put condor. And we went all the way down to like 5,900. So I went out to January 16th. I bought the 5,900. I sold the 5,890. Sold the 5,870 and bought the 5,850. So I went 10 wide profit trap, 20 wide on the credit spread. We got this trade filled for like 50 to 60 cents. This got filled last week, I think. We took I think it was 55 or 75 cents of profit. And it looks like this. So we have a profit trap, which is unlikely going to get filled, where, we'd have to be 15% away from current price, which I'm giving myself a wide room for error. We're going to make about $75 or so on the credit side. We do have a profit trap. It is tying up some buying power, but it's manageable. Like my buying power is, 900 and some dollars. That's max risk. So if I can make, $75 on 925 of max risk, 75 out of 925, I'm making about 8% return on that risk, which, is fine. Ideally, I'm looking for like a 15 to 20% return. But the reason I'm sacrificing some of the upside on my typical credit is because I want that profit trap to be there if I need it. Okay. But waterfall, it's one of my favorites. I mean, we have taken that strategy through, the Liberation Day sell off. We took it through the choppiness last year. We have won 94% of our trades. We've had 104 winners already in the service, and I just keep plugging away. I mean, it's one of my favorite ways to kind of reliably dollar cost average in the market, using it with risk defined trades, having some profit traps built in. You can make this a little bit more cost effective with my strategy 1. So we talk about that a lot in masterclasses. Okay. ABH. So I think you're missing the point here. This whole session is called Anatomy of a Trade. So I'm not doing my macro stuff right now. I'll save that to my final hour so we can blend that together. But I'm talking about Anatomy of a Trade right now. So I'm looking at option strategies for up, down, sideways. This is a class. This is a free trading session, a free education session. I'll get into the macro stuff in a little bit. Okay. All right. What else? So long calls, ratio spreads. I'll put these in all caps once we knock them out. So ratio spreads. Okay, the same thing applies to my long puts. Okay, long puts are, you got to be bearish on the market to go long put. If honestly, like, I am willing to go more like debit spreads on put sides. I'm also willing to just buy out of the money puts because volatility expands so aggressively on a downward move. Out of the money trades are pretty cheap. They don't have to cost an arm and a leg. And if volatility jumps from like a 15 VIX to like a 30, 40 VIX, you can get paid pretty well, pretty quickly. It's kind of like the black swan trade, which you know as well as I do, you're not going to have very many black swan opportunities, right? COVID was a black swan event. It was literally over and done with in 30 to 60 days. Liberation Day this year, it was over in 60 days. 2022's bear market, it was a little bit more, high to low, lower high to lower low. It was over in about 9 to 10 months. Once we bottomed out here, it was October, and then it ripped to the upside. So that was a more prolonged bear market. But we still survived a lot of that nonsense because every downward move was getting a reflexive rally at a lower high. And it did this many, many times over the course of, rolled over in like February, March, and didn't stop going down until it was like an April to October correction. April to October is about a 5-month correction. Technically, it kind of peaked in like late 2021, early 2022, and just rolled over hard. And once we had that first flush for like 10 to 15%, every pullback was just a lower high, lower low, lower high, lower low until the bottom was like October, November. And then from there, it was big bull market coming back in 2023. Okay, all right, let's keep going. Strangles, I'll save that stuff for tomorrow. Any of these, give me some chat. Give me something in the chat. What would you like to see here for maybe one more strategy to cover today? I also put in here, covered calls and collars. Those can be discussed. Iron butterfly. Somebody asked me that this morning. That's a trade that I tend to take in a 0-day environment. Butterflies are one of my favorites. One of my services called Double Ups. I take a lot of those trades because it's all about a high reward to risk. So high reward, low risk. Always high reward, low risk. Here is an example. So I'm a little disappointed that today I said this morning in my daily profit plan. I'm like, I think a double up to like 67.50 looks pretty good. And I said that, and the reason I didn't take the trade is because we had a pretty wild open. The markets dropped 50 points this morning and made this a way further out of the money trade, but yet we came right back up to it. Had I done a butterfly there at 67.50, which was where all my gamma was today, that would have been a hell of a trade. Seriously, like I probably could have gotten this trade for like a 10 wide for $9 credit, risking $1, and right now that trade would be worth probably $200-300, which is way more than what I'd be risking. The issue is I didn't take the trade, and I was kind of faked out by the aggressive 50-point move to the downside, which I think is fair in a 0-day environment. It's like we had a plus minus 40 on the day. So when the day started, we opened up right here. We had a plus minus 40 on the day. Markets came. This is the opening price. We went down. We are up. I'm curious where this is at. The market makers may have failed again. 96. The market's up over 60 points right now. Market makers are sucking right now at their job, but we still made money. Like our daily profit play today, we made money in this little choppy environment right here because it was down aggressively, up aggressively, and then some chop. We pulled a 50% profit on daily profit play. If I was still holding it, I would be upside down because 67.50 was my line in the sand today. And unfortunately, it's not going up high enough to threaten my defense trades because I had like a 75 by 80 or so. I don't think those are going to get filled today. So working orders on SPX, I don't think those are going to get filled. So anyway, I'll talk about the butterfly spread. My working trades, pending. These three were for this morning, daily profit play. Those are defense trades, broken wing butterflies. They didn't get filled. So call side, not even close. I'm not gonna change them. This one is highly unlikely to get filled. 75. It's like we're trading at 57. If we have another 20-point move on the day, the VIX did spike up to 21.76. Like that's the high of the day. If somehow this market keeps melting up, and it probably won't. We still have an hour left. But let's say that the market is going to keep drifting higher. If it drifts higher, this 50% ATR is around 67.70. There is a chance that I could still get filled on one of these broken wings. This is a 75 by 80. It's going to be close, but probably not this late in the day to get filled unless we're trading like literally at the money. So I think price would have to come up to like 75, 76, or 77 in order for me to get filled on this trade. I still like the trade. I still have a profit trap. But that's an aggressive, we've got to push another like 30 points or so for that to get filled. Could it happen? Sure. I mean, the 50% HR is right there. It's at 72. If it gets filled, I'm still very confident that trade is going to be a profitable trade for us, and it also has a profit trap. But if it doesn't fill, meaning price just says something like this, if we're up here and we stall and we just kind of chop around here at the close, no trade. And that's totally fine. We took our 50% winner here. Glad we got out of it, because otherwise we'd be taking on some heat. We're 10 points above our sell call level. So we'd be taking on some full risk right now. So I'm glad we got out of that trade with some profit. All right. Okay. Let's do this. Give me some options here. What do you want to look at? Butterfly, ironfly. That's probably a pretty simple one to jump into. I like this trade a lot. I'll do this one. I think this is fun. And then I'll get into some macro stuff. We'll talk big picture. So butterfly spread, or the iron butterfly, they're not the same. Okay. Iron butterfly, the butterfly spread is a 3-leg trade. Okay. The iron fly, or the iron butterfly, again, these are stupid names, but whatever. Iron butterfly spread is a 4-leg trade. This one is typically a credit for entry and exit for lower debit for profit. And this one is typically, as a standard butterfly spread, is a 3-leg trade. You do a debit for entry and exit for a higher credit for profit. Okay, this is a low risk, high reward setup. And this one is also a low risk, high reward setup. High reward setup. All right. What I like to do, and the way I like to teach my butterfly spreads and iron butterflies, is I use the famous saying by Wayne Gretzky, which is, I like to skate where the puck is going. Okay. I use this software every single day for my visual roadmap. When we started trading this morning, who can remember where our pre-market gamma levels were this morning? If you're in my daily profit play, our pre-market gamma was 6740, 6750. Where's price at right now? 59. So even though price went down 50 points, did it still get back up to those gamma levels? Yes. Okay. So if that is where order flows are taking us today, when the price is either at the open or obviously a little bit lower and it starts to come back up, a butterfly spread is a really nice trade that looks like this. Okay. So this is like double up strategy, which is a service that I offer for alerts. This is like double up 101, because if price is here, and I think that price can get to 67.50 today, what I'm doing on the trade is I'm going to put my trade, and it's like a profit trap where I think price can go. Okay. So if I put the trade in like so, and I would build this trade out where I sell 2 at 67.50, and then I decide on my width. So if I went, let's say 15 wide and 15 wide, what this means is I sell 2 calls. Okay. If I think price can go higher, I'm going to do this all with call strikes. Okay. So I'd sell the 67.50 with 2 contracts, and then I'd buy the 67.65, and I would also buy equidistant the 67.35. So does that make sense that it's 15 wide here and 15 wide here? That's how I get the butterfly trap on the option graph to look the same. So it's risk, profit trap, and risk. So my risk, if I took this trade this morning, it probably would have been trading for about $1 to maybe $1.25. That's my risk, to $1.25. And my profit trap would be worth $15. So if price was going to hang out today around 67.50, this profit trap throughout the day gets better and better and better as we get later into the day. So now that it's after 3 o'clock, this trade is probably trading for something like that. It's still not full profit yet, and the full profit's going to be literally at the price of 67.50, which we're above that now. But my question is, are we still in some profit? 67.65, we're still in profit. We still have about $300 to $400 of max profit on this trade. And if we go up higher, there obviously is risk if we exceed 67.65. But because we spent all afternoon around that 67.50 handle, if you're risking $1 to $1.25, I promise you that this trade is going to be offering probably $200 to $300 of profit today. So for risking $1 and walking away with $2 to $300 profit, you have a 200 to 300% gain on your position. That is a very excellent reward to risk strategy. So if you can indeed skate where the puck is going, position this for, a very cost-effective trade, we're basically throwing a net out there to see if price will come in and swim into our net, right? So my profit trap area is between 67.35 and 67.65. If price is swimming up to those strikes, I'm going to see that my trade would be filled for about $1, let's say $1 debit. Okay. And later in the day, when this market was up here towards, this is around 12:35, it stays here until like 1:30, it stays here till about 2:40. This trade is going to show probably $300 to $400 of profit because later in the day, you're perfectly pinned at that 67.50 point. Price spent a lot of time here. You're exactly where you want that trade to be. And so if my max trade was $1 debit and it's showing a $4 credit, how many of you would like to take profit on that trade? I'm risking $1. I'm walking away with $400 of profit. Thank you. That's a great trade. If my average winner was $400 and my average loser is $100 and I can win 50% of my trades, I'm going to make a lot of money. Yes or no? Very much so. Okay. That's how cost effective butterflies are. Are they super high win percentages? Well, it depends on how aggressive you want to get for taking profit. If you're trying to go after 3, 4, 500% take profits, you're going to have a low win percentage. If you're going after 50 to 100% take profits, you can probably win 70 to 80% of these trades. If you have, the software, like I said, helps me a ton. And it's my visual roadmap every single day. I can get a pretty good sense of where direction is going, where flows are going. And this is what helps me, skate where the puck is going, like I said. So this is real-time gamma, and it's still sticky. And honestly, by the end of the day, maybe this thing settles around 67.50. And if it does, your trade could offer you $900 of profit today, and you only risked $100. But it also could go above 65, and you're going to risk that $100. So anytime I see like those butterfly spreads, if I'm up 200, 225, 300%, I'll just take the profit. In fact, if I bring up here is my double up service. So double up service, we're winning about 60% of our trades. And the reason this isn't such a high win rate is because oftentimes I will literally take a trade up or down. If I'm going to skate where the puck is going, sometimes the market is so evenly matched that it's like, I'm not really sure where price is going to go. So I'll trade it both ways. And I win one and lose one. And as long as my winner is bigger, so just look at some of these exit percent returns. So I lost 58%, but I made 87. Win 26, win 75. I lose 90, made 150. 95%, 190, minus 70, up 520. Minus 100, minus 100. I lost some trades there. 158, 100, 221. 80% there, 140, 150. So, that's what I'm trying to do is I don't like to trade up and down. I like to kind of get a sense of where price can go and just have a single trade. But because I take a lot of trades, like I'll do a call fly for a profit trap. I'll do a put fly for a profit trap. They cost me maybe $200, $250 max risk. And I have potentially $1,000 of profit on each one, maybe up to, $1,300, $1,400 of profit on each one. That is enough to have one of those trades be a nice winner for me. And the one can lose, the one can win. I still walk away with, maybe $200 to $300 profit in one day. So that is a really great strategy. So what you think about this as far as the deployment is having an idea where price can flow for the day, which is why I use this software. I put in my butterfly spread, and if price spends some time up here, I take the profit. I don't usually wait this out all the way to expiration, especially if it's going up my direction. And I'd say between 1 to 2 p.m. Eastern time, if I'm up over 200%, 200% or greater, I'm taking profit. And the reason why is because this is one trade. If I'm risking a dollar and I'm up $3, I'll take it. I'm up $300. I'm risking one. That's a good return on risk. And I walk away. If I want to hold this expiration, I could get lucky and this thing could pin around 67.50. But if it slips higher, I lose. If it slips lower, I lose. My butterfly will get exactly to those wing prices by expiration. So anytime you have a triple digit return on a butterfly, I take the profit. Okay. Yep. And so, yeah, these are gamma levels. I use a software. This team, this is Dynamic Trend. They built me a 0-day platform. I do have a really good discount. The software runs about $3,600 a year. They built me an exclusive 0DT platform of about $900. It's like $940 or something like that for a full year. It's one of the most affordable gamma platforms that I've ever used. And I use this like literally every day. I was actually looking at another service called Spot Gamma. I follow Brent. I think it's Brent Kabucha. Great dude. He's been in a lot of podcasts. I listen to what he says. Spot Gamma is really cool tools, but it's like $2,500 a year, and it works, but it's expensive and it's hindsight. This is real time. He does have the thing called Hero and Trace, which I like, but $2,500 a year is pretty steep. I can see very similar option flows in real time for $945. That's a third of the price, right? So very, very cost effective. And I've literally used the software for 6 years. I would not trade 0DT without it. This to me is what I do for general flows, call levels, put levels, creating spreads. When I zero day trade, I am willing to throw in sometimes 2, 3, 4, 5 trades a day. Not all of them get filled, but it's like I'm trying to either skate where the puck is going or trying to defend my current positions with daily profit play. I wouldn't be able to do that without the software. Okay, so this is great. If you have any questions on this, I teach the software quite a bit. I do have like I said, they built me a 0DT exclusive software package. So if you're interested, you can hit me up on Discord or ask me. You can email me too. It's chrispulverpub@gmail.com. You can email me on that if you're interested. So again, no pressure for me, but I use that stuff every day. I've used it for 6 years. I love that software. Okay. VIX is down to 1873. We're at 67.58. Gamma levels are filling up a little bit here in the final minutes. Maybe this is a big maybe. If we get to like 70, 75, maybe I get filled on that broken wing, but it's doubtful. And I don't really care. It's like I want to get filled because I want the extra profit, but I'm also happy with just taking a winner and being up on the day. Okay. So that is the butterfly spread. So if you're looking to go, if you believe price can go higher, use the call fly. If you believe price can go lower, use a put fly. Okay. And what this is a combo trade of a debit spread plus a credit spread. Okay. And they're equidistant. So if I do let's just look at this trade. If I did it today, if I did the 67.50 like I talked about, if I were to buy the 67.35 call with one contract, sell the 67.50 call with two contracts, and buy the 67.65 call with one contract, can we agree? Let's say that was $1 debit. And I'm just throwing out there, it would have been about $1.20, maybe $1 to $1.20 debit. But if I did this trade, can you see that this is equidistant? It's $15 to the 35 to 50, and it's $15 from the 50 to 65. Now, the 35 to 50, if you break the trade down, this trade is a debit spread, right? 35 by 50, it's out of the money, which means this trade offers $1,500 of profit. And it probably costs, let's say, $1.50 debit. Okay. It's very cheap. So you're paying $1.50 to make upwards of $1,500. If price is greater than 67.50 on this trade, you have $1,500 of profit on that trade, or $15 of credit minus what you paid for it. Okay. And the other side of this trade is the 50 by 65. This is a sell at 67.50, and a buy at 67.65, which is a credit spread. And on this trade, it probably offers me, maybe this trade offers about 50 cents of credit, which is why this net position would be about $1 debit. Okay. And what I need price to do on this trade. So this trade, I need price to be less than 67.50. And on this trade, I need price to be greater than 67.50, which is why when you combine the two, that is why it is risk, profit, profit, risk. And so if I'm 15 wide, let's say this got in for $1 debit. These are my risks. If price is less than 67.35, I don't make any money. If price is greater than 67.65, I don't make any money at expiration. But for a close at 67.36, 7, 8, 9, 67.40, 41, 2, 3, 4, 5, 6, 7, 8, all the way to 67.50, that is a profit trap at the end of the day. 51, 2, 3, 4, 5, 6, 7, 8, 9, 60, profit trap. 61, 2, 3, 4, 5, break even. So I have profit traps in here. So if price is anywhere between 67.36, if I paid $1 for this trade, 67.36 to 67.64, anything inside this window, that is an $18 wide profit trap zone. If I get this trade right throughout the day, doesn't have to be an expiration, but throughout the day, I'm going to see some profit on my trade. This trade will look something like this. And then later in the day, it looks something like this. And then late in the day at expiration, it looks something like this. So if I'm inside the 18-point window, I can make a lot of money for a very low risk. Okay. So if you can successfully skate where the puck is going, you don't have to risk a lot of money to make 200, 300, 400% gains. You know, what's even crazier is getting like a pin price in the final, 30 minutes of trading, the final 15 minutes of trading. Some of my biggest gains I've generated over $2,000 in profit by risking like $200. That's awesome, man. Like that feels so good. It's not easy. And I don't love holding these trades at expiration, but man, when you can pull in, I risk $100 to $200 to make $1,000+ like that is a great feeling because you don't get that very often in these markets, let alone get that type of trade every day. Okay. So that's a butterfly. Skate where the puck is going, equidistant. It's a debit to get in, and you're looking to close it out for a higher credit to exit for profit. Okay. An iron fly is kind of a modification. Okay. You're going to basically create it's a combo trade as a credit. You're creating I guess technically it's a debit spread and debit spread. That can't be right though. Hang on a second. Let me look at this trade. If I do I think it's two credit spreads combined. Let me double check. If I did this right now, if I did a 60 and 60, I go 15 wide. So selling, okay, so that's a bull put spread, and so it's two credit spreads combined. I should have known that because I obviously take the trade for credit. So the iron fly, the way that I like to put the trade down, so an iron butterfly is you're going to sell a call and sell a put at the same strike, okay, and then buy a higher strike call and buy a lower strike put. So it's essentially combining two credit spreads, and with the sell strike at the same price, I should say the sell call and the sell put at the same strike, that is the pin price or profit trap center price. Okay, same type of thing. If I took this trade this morning, and I thought again, like I'm going to skate where the puck is going. I think 67.50 was a gettable level. I could do a similar trade with an iron butterfly, and I would do something like this. If I sell the 67.50 call, and I buy the 67.65 call. That's a 15 wide credit spread. If I sell the 67.50 put, and I buy the 37.35 put, together, that probably offers maybe like 13.50 credit. I'm just throwing it out there. These are, if you separate the trades, this trade, the Sell call and buy call is an out of the money. Okay, this is an out of the money. So OTM for out of the money, bear call. Okay. And then this trade, the 50 by 35, this would be an in the money. Because remember, we're talking about trading this thing down here, thinking that price can go up to 67.50. So if I did this trade, this would be an in the money bull put spread. Okay. And so the way this thing is constructed on a risk graph is you have your, let's say it's 13.50 credit, which means I'm risking about $1.50 on the trade. So there's my $1.50 risk. Here's my $15 profit trap. There's my $15 profit trap. There is my risk. This would be something along this line because I'm taking in credit up front. So I would have, I'm trying to think, where's my risk at? I guess I'm pulling in credit up front. Where the hell, how's this thing work? Why am I getting confused on the risk? I'm trying to think how to draw this. Iron fly. Credit. Yeah, that's okay. So on the outskirts. All right, that's fair. So let me go back to this. So my risk would be here. It looks almost identical to a butterfly. So 13.50 credit, and these are $15 wide. That means I'm risking $1.50, and I'm risking $1.50. My break-even price. This is what's kind of nice about this trade because I'm getting the credit up front. If this is still 67.50, my break-even price is 67.63.50, and my break-even price down here is 67.36.50. So my profit trap is if we are greater than 67.36.50 and we are less than 67.63.50, that is a $17 window. And I can max out profit in that window. Okay, is one trade better than the other? Not really. They're both trying to accomplish the same thing. Okay, so right now at 3:25 p.m. Eastern time, we are trading at 67.60. 67.60 is going to fall right about here on this profit trap. If we cash settle at 67.60, I have 13.50 of maximum profit, and I would take away from my pin price to my actual price. Let's say this thing, I'll just use a simple number here. Let's say that we literally settle at 67.60 at the end of the day. Okay. So I take my 13.50 max profit. Okay. And then I take away, since I go 50 to 60, that's a $10 difference. So I take away $10. I could walk away with $350 profit today on what was costing me $1.50 of maximum risk. So if I make $350 and I was risking $1.50, that's a 233% gain on the day based on return on risk. So whether you're looking at the butterfly spread, which is like casting a net, or you are putting on the iron fly, which is still throwing a net out there, the trades work in a similar fashion. If price is going to swim into your profit trap, you have a good opportunity to make more reward than risk. That is why, as far as low risk, high reward, these are some of my favorite trades. Okay. Trading zero DT without dynamic trend software would be akin to trading blind. Yes, I do agree with that. I've told this to anyone that's asked me. Anyone that's asked me, hey Chris, zero DT, I love you talking about this stuff. You know, how do you find these trades? How do you find these levels? None of this stuff is by accident. Zero DT is not a guessing game. Zero DT is it's what's funny is it's such an active. I mean, you can see a trade life cycle work from start to finish in an entire day from 9:30 to 4 p.m. Right? I mean, there's a lot that goes on with everything from your deltas, your gammas, your Greeks, your options, your time decay, your price action. All that stuff is happening every single day. So it is a very aggressive learning curve if you start tackling some zero DT. But the beautiful thing about it is, if you're trading zero DT with risk defined trades, you will get so many reps to learn how to trade. You know, and so all I'm encouraging traders to do if you're trading zero DT is don't take a lot of risk. Learn. I mean, when I started trading zero DT in 2022, I was trading like for millions of dollars in portfolio. So I was taking like literally one contract trades. I was just trying to get my feet wet and dabble with like what type of opportunities could I look at every single day. And I try to get long directionally. I try to do debit spreads. I try to just buy calls and puts because they were cheap in a 0-day environment. What I came back to is I like what market makers do. I side with market makers. This is how I've been trading daily profit play for the last 3+ years. I've done it on a bigger time frame, going out like 30, 60, 90 days, but now I can do it every single day. So that's daily profit play. And the 0-day environment is, gosh, I mean, we do this. It's not by accident. Like all this stuff is premeditated, pre-calculated, mathematical, probabilistic, and it's kind of a fun process every single day. Like we just kind of dissect the markets, put the puzzle together, and if we do everything right, we're typically getting paid every single day. And when you can do that every day, that's a lot different than, well, I do this trade once a month, because that's how it used to be. This trade wasn't offered every single day. This trade used to be something you got to do every week or every month or every 45 to 60 days, and you get way less reps, even though it's the same mechanics. Now we can do this stuff every single day. So yeah, I would say that if I didn't have this software, like I would be trading blind. I would have no clue. I would have no clue how to put debit or put butterfly spreads on. I have no clue where the puck is going, and I would not be trading 0D like I do. So this is a big part of what I do. And everyone that's asked me about this software and this service, they have it, they love it. I'm happy to also do some one-on-one sessions with you if you need it, some private workshop stuff where I'll go through it with you, because you get pre-market levels, you get real-time levels, and this literally flows and changes in front of your very eyes. So on my screens, on my monitors, my price action looks like this. I have 4 monitors set up every single day. And so I have my my gamma levels and 0DT stuff in my upper right. I have all my charts in my option platform in my bottom right. I have my trackers and spreadsheets to update here in my bottom left. And then I have my stream stuff, software, emails, everything else in my top left. And then this one gets dissected into like all these separate workspaces, so I can just multitask. So all my trading stuff this is all my gamma. So all my real-time gammas up here. My broker platform is here, and my charts. This is my spreadsheets, and here's my admin. That's my setup every single day. And I'm multitasking on the admin side, but if I didn't, like literally gamma, it's running all day. I need this stuff to see like, where am I going? Where's price flowing? Where are the option flows today? So it does help a lot. Okay, good stuff. All right, we're trading at 67.62. Any thoughts, any questions, any concerns on the butterfly spread, iron butterfly spread? Talk more about that happily. It's one of my favorite low risk, high reward strategies, and you skate where the puck is going. Long calls we did, ratio spreads we did. We can save, I'll delete this one. We can save some others for tomorrow. I'm doing an encore presentation here. Not a repeat of this. We'll talk about new strategies if you want. We can do that tomorrow. I'd like to get into like the diagonal spread. I really like diagonal spreads. Long straddle, short straddles, long strangle, short strangles. We'll talk about those tomorrow. Jade lizards, that's a bit of a specialty trade, but I do like that trade. Actually, I took quite a few of those when I want to sell puts. And then we can get into covered calls and collars. I'll cut that out and put that up here. Let's go here for covered calls and collars tomorrow as well. Any other strategies you'd like to assess for tomorrow? Again, we'll do another session tomorrow at 1:30 p.m. What I'm going to do now is switch gears into the final 30 minutes. Let's have a little final hour mashup and check real price. Let's see the tail of the tape. We're trading at 64. Can we get up to 70, 75 today? I do have a broken wing butterfly that hasn't been filled. It's not close. We have to trade this thing up to like 76 or 77. We really have to try to get to like 80, 85 today. If we get there, I have a chance of getting filled, but it's going to be tough. This late in the game, only 28 minutes left. We have to really scream up here towards like 70, 75. I do like the trade, but I'm pretty confident we also did a good job of calling the top today. So we used the VIX at high today was on 21.8. 21.8. It was 21.8, correct? Yeah, 21.8. Let me get that exact number. 21.77, 21.66, so 21.77. I feel like gigawatts. 21.77 by 16. That's a 1.36% move. And our day today, we calculated based on the open We had a slight gap lower. I did the previous day's close. So I go 1.36%. So from the close yesterday, up 1.36%. That pin price should be around 67. If we get there, that's up to like 95. Okay. So could we stretch and get filled in here? Yes. I don't. I'm going to see if we get filled. So 75 by 80, 85 by 95. That trade is why I put this on exactly at that pin price. This one's more like wishful thinking because I don't think we necessarily stretch another. We can go up another 10, 15 points, but here's my market maker move. Even right now in the final minute, it's only about a $5 to $6 move. So could we go higher? Sure. But you can see I have pending orders, buy, sell, and buy. This trade is showing a debit right now. It's not even close to my credit, but maybe we get a surprise move by another 10 to 15 points. So we'll see. The way this price is going to get filled is we'd have to go up to about 80 to 81. If we go up to 67, 80 to 81, this trade could get filled for $1. If it doesn't, it's not going to get filled. And it's no big deal. Okay. Chuck, what's the question there? Can you use the same formula when you trade a stock like SPX using the butterfly spread? Meaning this, you're talking about like using the software? Yeah, skate where the puck is going, man. The only difference on stocks is a butterfly spread isn't going to be an everyday expiration. My favorite way to trade a butterfly is trading 0 day because that's when you get the full profit trap. So if you want to trade butterflies on individual stocks, I would use them on a Thursday to Friday expiration. I wouldn't trade them on a Monday, Tuesday, Wednesday because you got to wait. If you want the big profit on a butterfly, you got to hold that thing to Friday. So if you're in on a Monday, Tuesday, and price is automatically going to your profit trap zone by a Tuesday, Wednesday, you're going to make a portion of the profit, which is fine. But it's not my favorite. I think the most bang for your buck is going to be when you get like that, 9 to 1 setup or 10 to 1 setup, and you get that thing, fully into the profit trap by expiration. Yeah, but it works. This stuff, same thing. It's like look at the gamma today. Starbucks started out around $83. It rallied up to 85, almost 86. That was my gamma pin, $86. But the problem is today's Tuesday. So if you had a butterfly spread on a Friday expiration, you're only up a portion of that profit because you still have 3 days expiration. Which, granted, the markets are closed on Thursday, limited trading on Friday, but still, if this was your pin price at $86, you're not going to get the full profit. But it's still a great strategy. It's just, maybe the way to trade this is if you are, long a call on Starbucks or you're doing a bull call spread or a credit spread, something like that where you can get paid a little bit faster. You might take a bit more risk on the credit spread, but you can probably turn an asymmetric debit spread. You could probably, if you did like the, 84 by 83, that trade's probably showing like 50, 60% profit right now. And you don't have to hold that to expiration. And if it stays where it is, you can probably turn that. The nice thing about individual stocks is a lot of times you can take bull call spreads for like 110% profit, 120% profit. So it's nice, but you're holding it to expiration. Yeah, but it still works. I checked. Anytime I'm looking at stocks, looking at flows here, you can check it with this dynamic trend for sure. I use this on SPY, Qs, Mag 7, any liquid stocks, any earnings trades, and really a lot of 0DT. So, yep, I love it. Cool. Okay, good stuff. What else? I'd like to do a little macro here. We're at 66. Let's set a chart alarm here around 80. 67, 80. What is my price here? I've got a 75 by 80. So if we get to 81, this one is 80. See, if we get to 80, 81, there is a chance we get filled on a broke wing today. There's a chance. Now it's a low chance, but that could be a pleasant surprise if we get there. We did call the high based on that 20 something VIX, 2177 VIX today. So to be like super safe, I really feel like we should probably just avoid the 75 by 80. Although I'd kind of like to see could price get up there? I don't see the gamma line. The highest gamma I have is at 75. I don't think we're going to get to 8. Technically my break even would be 85. So if price was going to go to 85 or 86 today, I have a profit trap if I get filled for that dollar. That's kind of the beautiful thing about this. This would be a break even of 86. And we're getting up to that highest calculation of where prices can stall today. So let's see what happens. I'll leave these in. I don't mind if they get filled. Awesome. honestly, in the next 22 minutes, that'd be a nice little treat, nice little surprise for the day. I say that, and then hopefully price doesn't finish at like, I mean, if it finishes at 90.95, then we should also get a profit trap on this trade too. But anyway, we'll ride this one out. I'll trade this until the close. They might not fill at all. Futures, yeah, let's take a look at some. So this particular zero DT stuff, I don't have this for futures. There is a futures feed, but it's not as liquid as SPX Gamma and SPY Gamma. So I look at SPY Qs, SPX. That's my most liquid. That's where I'm going to get the most like dynamic feed. So this is an aggregate feed of about 40 different broker platforms globally, and this gives me a pretty good real time feed. Futures wise, I mean, I have a workspace dedicated to futures. I trade futures pretty simply. If it's above the VWAP, I'm bullish. So here's an example on my futures dashboard. So I've got a workspace here, Chris Pulver Trading, and taking a look at futures this morning. Take this. This is a screenshot. The black line is my weekly VWAP. Okay. So I have the blue line is my daily VWAP. Blue line is weekly VWAP. Black line is daily VWAP. And above the VWAP means we're probably going to stay bullish on the day. You have your first and second and third band to show when to take some profit. You had a nice run this morning when this thing was above the daily VWAP around 10:30. Bullish. These are Heikin-Ashi candles, so it kind of stays with the trend. Pretty easy read here. If you're going to get out of the trade, you get out if it closes back below the VWAP. So bullish on futures, run this thing higher. Pretty good trade on long futures this morning. And even if you got out around 12:30, you'd be holding it all day. You're still, same profit. So I think that was a pretty good run. It also stretched all the way to my third band. So that would be the best run there is about, I mean, you could buy any time in here from 10 a.m. And hold this thing anywhere all the way up to this like noonish high. That's a pretty good rip. I mean, that's 60 points on a, ES. That pays pretty well. I mean, that's a $300 trade today. If you're doing E-mini futures or micro futures, that's a $300 winner. If you're doing ES, that's a $3,000 winner today. It's not bad, but it's a pretty easy read. So that's how I trade futures. Is VWAP is pretty simple. Keep it really, really clean. I like Heikin-Ashi candles in these bands, so I'm not like buying too high. I'm not selling too low. But if we're above the daily VWAP and above the weekly VWAP, I'm generally bullish bias. If we're below it, short-term selling or just wait. Honestly, sometimes it's way easier just to wait. Like, look at this. If you're trading futures in here, I mean, imagine selling in here, just getting beat up. Like, it just doesn't go anywhere other than keep sticking to that VWAP. But once we get a rip, it's just easier to be long. It's here. Same thing here. It's easier to be long, right? We get above VWAPs here. It's easy to be long. We're down below this. It's just chop suey. Easy to be long. So, yeah, pretty simple workspaces. That's my future stuff. Let's go top down. So today we're trading at 67.66. I mean, markets are up. S&P's up 0.9, SPY's up 9.7, Q's up 0.6. Dow is up Dow's up 1.52. Wow, that's a good catch up today for the Dow. Big rip on the Dow. Russell's up over 2%. Awesome comeback on the Russell. Seriously, awesome comeback. I am selling some calls on the Russell. In the money covered calls, I have a 204 right now, and I'm still just selling premium. My break even is all the way down to 180. My break even is 180. I'm selling calls at 204. Obviously, I'm sacrificing some of the upside, but I'm still generating some pretty good profit every 30 to 45 days. My in the money calls are allowing me to still grab an extra $150 to $300 every 30 to 45 days. So if this is going to go higher, great. I'll just keep selling in the money premium. But what a good comeback on Russell, up 2+% today. Doing some work. Russell's come back. It was a nice little bounce off that 144 to 200-day moving average. VIX, big crush on the VIX. We got the little ventilation that we needed. It's funny. This is the October 17th VIX high. This is the 16th. I mean, the big sell-off candle was the 10th. It's amazing that from the 10th to the 16th, the VIX went higher, even though price went higher. That's what's crazy. The 10th was a one-day sell-off, and the market still went higher VIX, yet the S&P went higher. That was a weird disconnect. That was the Mag 7. That was the broken market breadth. All that was a really weird phase for the market for a couple weeks. And here we have the big peak here for the NVIDIA sell-off on Thursday last week. That was another peak in the VIX at 28. So, this might have been the VIX ventilation that the market needed. maybe some de-risking, de-leveraging. Everyone that loaded up on puts got smoked this week because you're just getting a 28 VIX down to freaking nothing. The VIX has retreated so much already that probably crushing those hedgers. Move index, nothing crazy there. Dollar index, stalling at the 100 handle. I do think by the end of the year, the dollar index is going to be a really, really key component to where this market goes end of the year. I keep saying this, but we are making slightly higher lows right now. And if the dollar is going to break and go higher, I do think this is a risk off environment. So just be cautious of this dollar. If the dollar goes stronger, I don't think the market's going to have a great time closing higher for the year. Okay. But to that degree, if the dollar is going to roll over, if we roll over and sell off into the end of the year, I think this is risk on in assets. I think this is maybe a bottom for maybe Bitcoin in the short term, and maybe Bitcoin can stabilize. This is another rally back up to all-time highs in the equities markets. This might be a good thing for Russell. This might be the rate cut getting priced in even through 2026. The market's always forward thinking. So I do think this is a big gauge for where this market takes us in the next 30, 60, 90 days based on the dollar index. Where does it go? Risk off or risk on? And I think the assets that I just said, S&P, NASDAQ, gold, silver, Bitcoin, I think they all move based on a risk on, risk off flows. Okay. All right. What else? Oil. Oil is kind of retesting the yearly lows. We had lows here back in May, lows here back in April. Perhaps those lows are going to come back and get retested. I don't think that we go down as low as 50. My option trade that I have for oil futures is all the way down to $50. I think it's still doing well. Let me check on that position right now. It's up $160 out of a max 220. I also have a $500 profit trap. This is a project options edge trade. So as long as price stays above 49.50, I've got break even. If we stay above 50, I'm full profit at 220. If we get between, let's say we're close to 50 on the nose at expiration, I have a $720 profit trap. So we'll see. I think this is going to be a $220 winner when it's all said and done, but I'll ride this thing out. Gold and silver, natural gas, 1385. I'm hoping that natural gas makes a screamer back up to 20 plus. Gold, don't get excited about gold. Long term, I'm certainly bullish on gold. Any pullbacks, I'm buying dips on gold. I'm doing ratio spreads and naked puts and all sorts of exposure, but I'm patient. I don't think gold goes too far, too high without having to pull back into some of these moving averages. Silver, not as extreme, a little bit more volatile, but same type of thing. Maybe ranging down to this $46 level, maybe down here towards 42, 41. I still want to buy dips on gold and silver. Bitcoin, better than watching this thing go like a falling knife. But price action here, it's you're looking for some stability. This would be potentially a good look to it. If Bitcoin is going to, hold this low, it'd be similar to this. Right, we put in a low, we reflexively rally, we come back down. It's let's see some bottoming in here, and then see price start to get up for higher lows and higher highs. Obviously, this is a big change of events. If we get back up to breaking this trend line, clearing the 100 handle again, this might reignite some risk appetite. I don't know what the macro backdrop is going to be. We probably have to have some risk on trading. If NASDAQ, let's say the QQQ is at all-time highs, we're probably going to see Bitcoin greater than 100K again. I just want to make sure that if we get to 100K, it better look like it's pretty bullish and stalling over here to then build another charge to the upside. Because if all we do is we, bottom out, rip to 100K, and then pull right back down below this trend line, that is a wait and see. I don't think we're super bullish yet. So I'd almost rather see this thing stall here, build some type of falling wedge, and then start to work its way out, and then make some highs where once we get above 100K, it just looks like it's ready to rip. That to me is a better kind of technical setup on Bitcoin if we get that type of trade. Okay. What else? And what's happened in non-US? So copper, fine. Copper was crazy this year with that disruptive tariff trade. Japanese yen, oh my God. I can't bring myself to freaking buy Japanese yen futures. I'm long FXY. It's just one of the many hedges that I have. I'm looking at this is a trade that I'm owning FXY kind of indefinitely. If we ever have a risk off event, this could be in the next 1, 2, 3 years. If I hold FXY long, I think this trade potentially has a 26% gain to it. And for a currency trade, that's a lot. Um, the only reason I'm not just loading up in futures right now is because there's a finite window. If I trade futures, I can only go out to, let's go 6J here. If I can go to futures, Japanese yen futures, I can only go out to June of 2026. That is not a big enough window. I have no idea when the Japanese yen would get stronger. In fact, I have no clue. Like, it might be years until the Japanese yen gets stronger. So what I am doing is I'm holding EWJ, which is like the Nikkei. It just removes the bottom 15% of the Nikkei. I hold this long. I've been long here since a break even about $66. I want to see if we can break some new highs again. I've set a chart on there. And DAX Germany is right back to the 200-day moving average. I think this is still looking good for the upside. FTSE, a little pullback. I'd almost like to see the FTSE back down to this like 144 to 200-day moving average. This would be a good spot to maybe consider getting long again. There is a pretty decent play and narrative out there for getting non-US stocks to outperform. Reason why is because they're not priced to perfection. Okay, non-US stocks just have to not suck, and their price to earnings is like 11 or 12, versus ours are Mag 7s are like 33. Our overall stock market's like 22 or 23. Europe stocks, non-US stocks are like anywhere between like 8 to 12 price to earnings. And if they just have a mediocre year, they probably outperform. If they have a great year, they will crush the S&P because we're at just these crazy high valuations. So non-US is great. One of my favorite ways to do it is SCHY. That's a Schwab non-US ETF. That it's like, I think it's 100 plus symbols that are all diversified between Europe and Asia and India. A lot of stuff non-US. So I've got some good exposure there. Argentina, I'm out of that trade. Brazil looking for just fresh highs. So my goal on Brazil is to try to take this thing up into the 40s. I'm long on this thing to 20. It's like low 20s ownership. If I take this in the 40s, I'm trying to go after a double. So $40+ would be a great double. All-time highs in this around like 47, $48. Okay, ladies and gentlemen, we're at 67.73. Let's see if that little butterfly is maybe showing some credit here. Not yet. That is interesting. I mean, we are not slacking. Like, this price action, we're at 72 right now. My break even. So honestly, if this thing gets up to like 80, 81, I might get filled on a broken wing. Maybe. My 85.95 is still showing zero credit. And it's just because we have 9 minutes left. I don't think this is going to fill. Which is annoying because I put it there for a reason. If I did a credit spread, does this thing, it's so late in the game. It's like, could we have a credit spread at 80, 75 or 80? Let's check. Let's go 75 by 80. Uh, 75 by 80. It's just crazy how this drops off. If I do 80 by 85, I get 20 cents credit. If I go 75 by 80, I get $1.15. Now I'm risking 375 in that trade, but that puts my break even around 67, 67.76 and change. That it's risky. It's just like an all or nothing trade. There's not much I can do in 8 minutes other than, hope this thing stays below 75. So that's probably a dumb trade. I'm going to sit and hang out here. It's like maybe 8 minutes. This might get close to filling a broken wing, which that break even, by the way, is like 86. So I'm going to keep a close eye on this trade. It's really weird that it's right now showing for a $1.25 debit when a broken wing should be offering a credit trade. Buy, sell, buy. If we get up to like, I don't know, 81, 82, this might fill for some credit. And my break even would be 86 on that trade. So let's see what happens. But we've done a pretty good job of calculating the top. Here's my biggest gamma now at 75. It's more difficult in the final 8 minutes to get up to 80. We did calculate out the high to be roughly 67.95. So, could we get there in the final 8 minutes? Maybe. I would say pretty unlikely, but anything is possible. So I think what is just a positive note is that the market is trying its best to get back above. Look at today's price action. Okay. In the last 3 days from Friday, Monday, Tuesday, we have taken back this entire sell off from Thursday. It took a lot longer to do that last time. When we had that October 10th candle, this was 1, 2, 3, 4, 5, 6, 7, 8, 9 days of indecision before they broke up. This is now 3 days in a row that we've basically taken out the highs. That's a pretty convincing move. So, we're back above the 50-day on the simple. We're back above the 50-day on the exponential. It's important that the bulls have some follow through as we go into the holidays. If we turn around and fail tomorrow, I question the follow through a lot actually. But if we are pushing higher tomorrow as our last day of trading before Thanksgiving and limit trading on Friday, then this market might come right back to these highs, which obviously would be a great recovery. And everyone that's like crazy bearish and oh my god, this is the AI bubble, you're wrong, right? All right, how are we doing out there? I haven't seen a comment in a moment. Chuck's been filling up the chat, but who else? Anything else? All right, 76. Let's keep an eye on this. If we hit 80 to 81 today, I hope we freaking get filled on this trade. But I think what's happening is now my debit spread is so expensive that it's just not going to fill. All right, let me do that 75 by 80. $1.30. And just look at that thing. $1.30 down to 75 cents just like that in these final few minutes. Now it has to stay below 67.75. So this trade's not done, but isn't that crazy? Like it's so fast in these final minutes when it's just there's no time left in the trade. It's like it's all or nothing. So anyway, we'll see what it does. This 75 is not joking around though. This 75 could still get pushed. We might squeeze up here to like 80-ish, but I still think it's kind of unlikely this fills today. Let's see. Is that you, Mike? I have a 0 position in gold. Safe place to sell a gold put in GLD. Yeah, I'm down to like the 300s. I talked about this yesterday in one of my live sessions. My trade on GLD. Let me check here. GLD. I have a 260. So I've got ownership potentially at 260, ownership at 280, and ownership at 320 and 340. So I'm using ratio spreads to do it because I'm looking to build out. This is a $500 profit trap. This one is a $500 profit trap. This one is a 15 and a 20. So if I'm going a little bit higher up in my strikes, I'm going to get a $15 to $20 profit trap, which will lower my cost basis to like $300. So I think anything in like the low 300s is a good starting point. And I'm going out like this is out to summer of next year. This one's out to January 2027. Long term, I'm pretty bullish on gold. I just need to get some discounts. All right, SPX. Just curious in this final stretch, 70. We're at 70 and change right now. I'm curious where this thing closes. So $1.80. If we get back below 70, this is not a bad like sneaky trade for the final few minutes. I think this 75 by 80. If this gets back up to like $1-ish, which it may or may not. But anyway, no reason. I mean, there's no reason to force a trade. But always curious how 75 is a pretty good fill at that $1.20, $1.30. It's holding nicely. Now we're at 69. You got about a $6. You got a $6 buffer. But 3 minutes, we might try to finish up high in the day. It still doesn't fill my broken wing, which is fine. I'm just happy that we are not stuck in a daily profit play. So we got out over here around 11 a.m., 11:15 or so for a nice 50% winner. And the prices continue to trickle higher. We didn't quite hit my VIX measurement move, but that's okay. So our defense didn't have to kick in. We took a nice little 50% winner. And, price never threatened or exceeded our defense levels. Any fundamental reason why price is rallying beyond the market maker move? Yeah, because there's less volume. It's less volume, less liquidity. The markets are drifting. Market makers are probably just going with the flow because there's less volume in the markets. And so they're going to roll risk until they are properly hedged. Like their job is again to hedge. So if price flows are going to the upside and there's no counterparty, market makers will just hedge the risk. So if they're looking at, selling, let me change this to yellow. If they're selling calls and selling puts, remember this morning I said about 66.95, above 66.95 is positive gamma. What that means is everyone is selling puts. So you're selling puts and you're selling calls. Now, what the easiest thing to do is when you're selling calls, you just buy a call. So you buy a call and neutralize that risk. And so they can run with this flow. They can sell puts and get paid. They can buy calls and hedge. So they're neutralizing the call side risk and they're still selling puts to make money. That's how they're letting it go. And because this is kind of thinner volume, there's just, this is where the market was noisy this morning and then order flows prevailed. And a lot of the option flows were positive gamma. That means they're selling puts, they're selling calls, and the market just drifts up. So, and this is also why we talk about managing profit through our trading day, because sitting on this thing all day is not the plan. Take your 30% profit. If you're holding out for 50 plus percent, that's fine. But anyway, and that 70 by 80 or 70 by 75, a buck 80, $2, that worked. Cool. Final minute, 65. Not stepping in front of this thing. It's like, it's silly to pick up pennies from a steamroller. But that 75 by 80 would have been a nice like buck 35, buck 40 to grab at the end. Okay, last minute here. Let's see where we close. 65 by 70. You get $1.50. See where this thing settles. I'm showing 67, 65. You'd make a partial profit there, about 60, 70 bucks if you took that trade right at the close. Not worth it, honestly. Not worth it just to sneak it in there, because that could easily go a dollar against you and you lose everything. So anyway, happy on the day. Daily Profit was a winner. No defense trade kicks in. We had a high at 76. We were close. I mean, we had a trade. We needed this thing go to like 80 to 81. If we went to 80, 81, we would have been very close to getting filled on our broken wing butterfly. But it's a game of inches when it comes to these strikes. Like there's a lot of precision on those defense trades. Let's see here. Chuck says working with a small account. So changed over to SPY. It's much cheaper using the same formula. 5 winners last week. Good. Yeah, you are using like butterflies or Chuck? Butterflies on SPY is great. How wide you going, man? You going like 2, 3, 4 wide, something like that? I mean, if you went like 2 wide or 3 wide, that's like a 20, 30 wide on SPX. It's a fraction of the price. The average move is about $3, $4 a day. I mean, the SPY today was a pretty big move. SPY is up over $6 today. But we started out with that wild start to the day with a bit of volatility, and that would have been a pullback. Let's take SPY today. Let's go short term. SPY here. So SPY for the morning, we opened. This is a 50-minute chart. So we opened this morning, faded, really aggressive down to 64. I mean, this thing went up 11 points from the low. Ended up finishing a net, 629. But I mean, that 674, 675, that would have been probably the equivalent of my 6750 as far as my gamma level goes. Pretty close to that on the SPY. So yeah, man. I mean, SPY is much cheaper if you're looking for the butterfly spreads, especially low accounts. Butterflies are great, low risk, high reward. Get your roadmap for some gamma. Looking pretty good. 2 wide on butterfly spread, broken wing butterflies. Yeah, cool. Just make sure you're not taking on a ton of risk on the broken wing. A broken wing, like it's really important that you set that pin level where you want it. Yeah, that's all. Don't accept like, you make, 50 cents on the SPY to risk $5 or $10. Like that's unnecessary. I'm risking 1 to make 4. I'm risking 1 to potentially make 6. That's a broken wing in my wheelhouse for SPX. I'm trying to make it pretty tight risk. So good stuff. All right, cool. That kind of wraps us up for the day. We did gold, we did silver, we did oil, we did dollar, we did assets, we did US, non-US. That's it. Like good day overall. We are back above. We didn't close necessarily above this wick high, but tomorrow is Wednesday. We'll see if we stay in a positive gamma. This is an encouraging sign to have a 3-day recovery. I warn this though, if tomorrow's trading day is going to retreat from here, then it's a noisy stretch. We're still inside of this NVIDIA candle if we sell off tomorrow. If we go up tomorrow, great. Path of least resistance is trying to get back to these highs. Okay. Is this market free and clear for the bulls? Not necessarily. We could get to these highs, stall at the top, come right back down. We're not done. Okay. And what would be even more confusing would be we come up here to the highs, we go a little bit higher, and then we roll over all the way back down to the same floor again. Now we're talking a bigger head and shoulders. I have legitimate pattern concerns for that type of trade because if we break that floor, measure this thing, and that's a legitimate correction. Now I could still be wrong, but I've got to be mindful of up, down, sideways. I do not want to be on the wrong side of a major sell off. And I'm also not going to be aggressively, hoping and praying that the market can rip higher. So many trades can make money if we go up. My entire portfolio can go up hundreds of thousands of dollars if we melt up. I just want to make sure on the downside, I'm not going to be taking on a bunch of risk. That's all. So good stuff. Okay. I'll let you go. Hey, look, thanks for being with me today for the anatomy of a trade. I know we got into some live trading. I took a ratio spread today for Project Options Edge. I put that in Telegram, put that in Pulver Alerts. Dissected a few strategies today. We did the butterfly spreads, the iron fly, the long calls with the rule of thumb on managing at the halfway point, the in the monies, at the monies, out of the monies, ratio spreads. Tomorrow we can throw in some more. If you got some strategies you want me to take a look at, come back and join me tomorrow at 1:30. Let's talk about it. Okay. So bring me some strategies, let's talk some directions, and we'll get a game plan for anatomy of a trade tomorrow at 1:30. It's the day before Thanksgiving. Let's see what the market does. I'll still be live tomorrow for Daily Profit Play at 9 a.m. Eastern Time. I'm trying to think if I'm missing anything. Tomorrow morning, Daily Profit Play, same time, same place, 9 a.m. Eastern Time. I think that's it. If you have any questions on the foundational stuff, if you want practical options, $27 for the quick guide. Full course is $497. Prerequisite education. I built it for anybody that wants to know how to trade some options and do it a lot faster than what your typical. Look, I've read Options for Dummies. I've read Simpler Options. I've read the Unlucky Guide to Investors, Investors Guide to Trading Options from Julia Speen at Tasty Trade. Brian Overby's Options Playbook. What else? There's probably 5 or 6 option books that I've read. They're fine. It's just, I took all that knowledge and I built something where it's like, if I'm going to give this to somebody with a PDF, with examples, with videos, get you up to speed, start talking some practical, some applicable trading strategies, this is what I built. So, I love options. I think it is the most dynamic tool that you can trade in the markets. I trade options on indexes, on stocks, in futures, in currencies, in crypto, options in everything. It helps me risk less, make more. It helps me manage my portfolio better. That is the most important thing when it comes to surviving these markets is managing risk. Upside is pretty easy. There's a natural bias baked into the market. Play that house edge, be long term, but there's ways to make money, up, down, sideways, which is why we had this segment today for Anatomy of Trade. So good stuff. Okay. All right. I'll be back tomorrow for Daily Profit Play. I'll be back tomorrow afternoon for Anatomy of a Trade. All of you are welcome. Spread the word. If you're, in any type of trading communities, Discords, if you want to come in and join me live, this is for everybody. I'm here to teach. I hope it helps.